All right, everybody. Hey, good morning, good afternoon, or good evening, wherever or whenever you're watching this. We are honored to have you guys join us here on our Note Weekend training class or our Note Investing 101. It's kind of the Cliff Notes version of our longer 3-day workshop. We usually have people join us from all across the United States, East Coast, West Coast, everywhere between, and then often we'll have an international flair as well. Uh, but this webinar, this training call is going to last about 2.5 to 3 hours, depending on questions. Sometimes it goes four, depending on the questions that you guys ask. And we are here to help you guys get your ball rocking and rolling, to get your feet wet, dipping your toes in the deep end of the note investing pool to see if that's something that you enjoy. See if you like how I teach, actually, as well, too, for a lot of folks of you that are thinking about taking my 3-day upcoming workshop that we host once a quarter, our Note Buying for Dummies workshop. But we are going to have some fun today. I enjoy teaching this class. It's a good way to kind of go through the cliff notes of what it is to invest in non-performing notes. Now, that's what we're going to be basically talking about, buying and investing in institutional debt. Yes, you can buy notes direct from banks, lenders. There's a ton of institutional quality paper out there, performing and non-performing or reperforming as well, that you can buy without the headache of sending out thousands of dollars or thousands of letters in direct mail costs, wasted stamps and time to owner finance sellers. Those and that marketing piece is not an effective aspect in 2025. I'm a big proponent of being smart and working smarter, not harder, using technology and this little thing called, oh God, the internet and Google to help you find deals out there. And not only just one deal here and there, but multiple deals, getting banks, lenders, and other sources to feed you deals on a regular basis, because that's all what we work for as real estate investors, right? It's all about the leads. It does. I don't care how good you are at the nuts and bolts of breaking out an asset. I mean, don't me wrong, that's very important, the due diligence, the evaluation. But if you can't find a note deal, if you can't find lists on a regular basis, you're not going to be in the note investor very long. And this is why so many real estate investors focus on trying to do 20, 30 different niches because they want looking for types of deals and leads in their market. The beautiful thing about what I'm going to teach you is your entire United States is your market if you want it to be, or you can narrow it down to 3, 4, 5 states if you want to. That's the smart thing to do. I wouldn't necessarily rely on just one state because we all know things can change. Um, I've been buying in about 30 states, golly, going on almost 20 years now. Well, 15 plus anyway. 20 years since I bought my first note and went full time as a real estate investor. But anyway, guys, we are here to help you achieve your dreams, help you take that next step. Like I said, if you're looking or thinking about becoming a note investor, diving in that from your niche because you're burnt out from fix and flips or REOs and tired of dealing with toilet tints and trash outs and drama, then note investing is the next evolution. Somebody said the other day, I was on a podcast with Corey Raymer, the Wisconsin real estate investor. He goes, all real estate investors I know want to evolve into being the note investor, to being the bank, and it always pays to be the bank. And guess what, ladies and gentlemen, you can do this without requiring a ton of money, a ton of experience. The way we teach and through our workshops and our YouTube videos and our podcast, all number ones in number one in the niche out there. We definitely, you can do this today. I don't care how old you are. I don't care how young you are. I don't care what your experience or what hard knocks you've been through. I don't care how educated you are or how undereducated you are. Note investing, there's a place for each and every one of you. No, you just don't have to go into flipping and starting off there. You can actually use the same tactics that you would be to be a wholesaler to be an effective note buyer and raising millions of dollars in private capital for your own portfolio. So let's dive into today's content. I'm gonna tell you right now, I expect you guys to ask a lot of questions. There are no dumb questions. The chat roll is open for you. If you're watching this after on a replay, feel free to type your questions in there. Somebody monitors the questions on YouTube. That's yours truly, because I want to answer your questions. I want you to be note buying smarties, not dummies. All right. Uh, and the thing is, ladies and gentlemen, there's a lot of misinformation out there. There's a lot of people saying things that are not accurate when it comes to you being able to buy notes. Yes, banks will sell you notes if you just know where to look. They will also, um, you got to say the right things. You're not reliant solely on somebody who's telling you that, oh, you notes, banks won't sell you notes. They will sell you notes. Maybe not going to buy from Bank of America, Chase, Wells Fargo, or Citibank, but there's plenty of other lending institutions out there that can help you get rocking and rolling and start buying notes now. And you don't need to have millions of dollars to buy a portfolio. Guess what? There are plenty of opportunities out there that are $100,000, $50,000. Under that too, that amount too, if you want to get rock and rolling. I usually like a little higher valued asset, but guess what? We got plenty of our students who have bought plenty of notes, non-performing, performing notes at lower balances to implement their self-directed IRA or their ESA for their kids or other things out there to get the ball rocking and rolling. And we'll go through a lot of this stuff here for you. Like I said, there are no dumb questions. I am just trying to jump over here real fast to be able to monitor the YouTube chat here real fast. Give me 1 second. As it should pop up. There we go. We're going live there. All right. Now we got that up there. We got one person watching. Do me a favor. Type in the chat roll if you are live and on YouTube. Tell me what part of the country you're joining us from. I know we got some folks from the Dallas area. Good morning, Greg. Somebody from San Antonio. Good morning, Fernando. I'm sure we got somebody from California, Eleanor, probably join us on YouTube. Glad to have her. Maryland, Maymernaz. Hey, what part of Maryland? That's always a good. Tell me your city and state so we get folks out there because we get. Let's see who else is on here. I can tell you right now. So Fernando, Greg. Let's see here. Tony Miller out of Florida. Hope you're doing good, buddy. I know that you've been dealing with some health problems. And glad to have you on here. Let's see who else we got on here. San Antonio, Texas. College Park, Maryland. Is where. Okay, awesome, good stuff. Let's get into this. Your time is valuable. It's Saturday during the summer. I'm sure you're enjoying the AC. It's probably going to be a hot one. I know it's going to be a hot one here in Austin later on today, but definitely we'll probably run to, like I said, about 3.5 hours. What we've been seeing this go for the last couple months. We've done this. We will restream the broadcast tomorrow across all our videos, all our YouTube, and then we'll also leave the video up on our YouTube channel for you to be able to go back and watch this again. But I encourage you guys to take advantage of the couple of the different promos we're going to have throughout this. Our upcoming workshop is July 25th through the 27th. That's just in a couple of weeks. We're offering a nice discount off the normal price of $9.97 for those on here. Or you can sign up for our monthly membership too and get a huge discount on the class and be able to tap in some cool tools that we've got rocking and rolling for you. Hey, Denise Herbert, you're out of Connecticut. Nice. Thank you for joining us on here. No problem, Tony. Hope all is well. We'll pray for you. All right, let's get into this here. So, Note Weekend Training, we've been doing this for a while. I'm Scott Carson. I'm known as the Note Guy across the country. Been an active note investor since 2007 when I bought my first note. Been an active real estate investor since 2001. Love the note business. Fixed homes. I've flipped properties. I rehab plenty of stuff. I've wholesaled, done a lot of stuff. I really love the note investing niche for a couple reasons. The three biggest things is once you make a connection to a bank or lender, they're going to feed you deals on a regular basis. That regularity can be weekly, it can be monthly, it can be once a quarter, it can be once a year. But it's a source that will feed you on a regular basis. Two, by buying the note, especially non-performing stuff, we're getting stuff at bigger discounts than your retail buyers or retail investors. And third, since we're buying at bigger discounts, that results in higher returns. And the higher the return for most folks is higher risk. For us, the higher return is less risk actually. It means we're buying at a bigger discount. So we got a lot more stuff being in the driver's seat. So yes, we're very honored that WeCloseNotes.com, our main website there for you guys to check out. And our trainings are the #1 investor recommended for note investing out there. Check it out. We've helped thousands of people dive into the note investing space and be successful. And our one-on-one coaching program is the best out there as well. But anyway, let's kick this thing off by giving you some tools that you can rock into. Like I said, ask questions, but keep them on point. That's the thing I require. If I'm talking about how to find deals, don't ask me a question about raising capital. We'll get to everything for you, and there's going to be plenty of opportunities at the end for you to ask questions if I don't cover them directly on here. Now, the big thing is we are not going to learn everything about note investing in a 3-hour Cliff Notes course, all right? But it's a good starting point to give you an idea of the higher level points to go into, okay? All sessions are recorded. Yes, we'll have the replays out tomorrow. Rebroadcast them, and we'll also send you an email with the replay video as well. Respect your fellow investors. If somebody, not that this happens, but if you have somebody that's commenting or making questions, don't be rude to people. Give everybody the golden rule and treat everybody like you want to be treated. And we encourage you to network with us and others that are online here. So feel free to drop in your LinkedIn URL. Not right now, but drop them in. Oh, let me go and I'm going to have to change something here for you guys to be able to do that so that you can communicate with everybody so everybody can see it. So let's go on here. Boom. Okay. Now it should be changed. So if you drop a comment or your LinkedIn URL, everybody can see it if you're here on Zoom. If you're watching live on YouTube, I encourage you to go over to noteweekend.com and join us live on the Zoom call. It'll send you a link to the newest Zoom link. All right. And there's also something, if you haven't checked out, we have a Note Nation Facebook group. Check it out. It's about 1,000 people. Connect with me on LinkedIn or follow me. And like I said, if we've got some time at the end of the day, we'll open up for networking for you guys to actually come on live via Zoom, share who you are, what you're working on, and then kind of what your focus is in the note space. And we'll be glad to go from there. So maybe even a little bit of one-on-one coaching for you. Some other resources for you, free resources. Obviously, we have our Facebook group we talked about. We have our YouTube channel, WeCloseNotes.tv. All right, that's the #1 YouTube channel out there for note investing. You can always book a call with me. Here's the thing: if you forget anything else, remember that if you have questions about a note or a note deal, and you want to talk with Scott Carson, you can go to talkwithscottcarson.com, and that will take you directly to my calendar to book a call. So I encourage all of you to do that right now. Go to talkwithscottcarson.com and book a call with me. I'm glad to visit with you. It's a 30-minute phone call, figure out where you're at. I love talking to students. I love talking to people new in the note industry, new real estate investors. We want to help you achieve success. And yes, that's directly with me. And you'll see what my schedule looks like and be able to book a call that works at your earliest convenience. Now, if that doesn't work, you can always shoot me an email at scott@weclosenotes.com, and we'll be glad to. And people know that I answer my phone. All right. I do answer my phone. And I'll give you my cell phone guys here later on. But the next steps obviously would be, after going through our workshop here today, is attend the 3-day No Buying for Dummies workshop. Like I said, that's a whole day on finding deals, a whole day on funding, a whole day on the exit strategies and making money on that stuff. All right. We have a monthly membership. It's $97 a month, the biggest bang for the buck. It's got some great bonuses and some new things we're adding to it. We'll discuss that later on. And then, of course, we have a one-on-one coaching program. If you think note investing is for you, we do offer that as well. But the question I always like to ask people is, what do you want to accomplish? Why are you here? And that's your opportunity to type in the chat roll. What's the biggest thing that you're looking for spending your Saturday or Sunday with me here? Why are you here? What are some things that you want to learn? Obviously, we want to learn about notes. That's no dummy. But what attracts you to notes? Is it being able to do this passively? Is it being able to do this from anywhere in the country? Are you burnt out on other facets? Are you looking for cash flow without all the work? Give me some ideas. Type in the chat roll. You're looking to retire yourself. I know Sanders on here. He's probably looking to put his wife's IRA to work. We've talked with him before, which is great. There's nothing wrong with that. Looking to get education. That's great. Education is phenomenal. But one thing that's important is taking that education and applying it and putting it to work. All right. We want you to guys get to work. Look, education is one of the best things. You learn about things, learn about things. But I want you to come from the ready, aim, fire. Getting ready is education. Aim and firing is just as important. And for a lot of you folks out there, you're as smarter than 99.9% of people out there. But it's that aim, fire that you struggle with. Let's get you pulling the trigger, get the ball rocking and rolling for you one way or another. Mehmet says, I love to deal with real estate. Okay. Are you trying to be a jack of all trades, Mehmet? What's your primary focus? Why do you like note investing? A jack of all trades is great, but you're a master of none. And all the successful real estate investors I know focused on 2 categories for the most part. Denise is looking for cash flow. That's awesome, Denise. Great. Glad to hear it. All right. Greg says, having the security of the property, but wanting to get rid of the JOB. Amen to that. Just over broke, Greg. And this is a great way. We've helped many of our students replace their incomes from their JOB into full-time note investors. All right. Or they have their, help people with their problems. Okay, I don't know. That's great, but you got to take care of yourself first. We don't deal with the borrowers. Now, I'm going to tell you it a little bit differently. I'm not talking to borrowers. Those are for our servicing companies and our attorneys to deal with. All right. People, yes, there's issues of people facing foreclosure. They've lost their job. That's all great, but I don't have people call me up, hey, Scott, can you buy my note? That's not a good thing to do. I also, if I am taking a note back, I don't keep people in their houses. If we've got to have to go to foreclosure, I'm foreclosing them out and getting them out. We give them plenty of opportunity to stay in their house and get back on track. But you have to approach it in a little different mindset. Hey, you don't run a charity, you are a bank. And that's a different hat you have to put on. We have different hats that we wear as real estate investors, right? I've got the landlord hat. I've got the banker hat, right? Or I have the note investor hat. The note investor hat is what you're going to focus on today for cash flow. C stands for cash flow, and this also stands for the Cubs. But you get what I'm saying is you have to wear the right hat as an investor. Too many people get in a note investing game without getting educated or understanding the ins and outs, and they end up screwing themselves over because they overbid or they didn't understand that it was going to be, they're not going to own the property right off the bat. So keep that in mind. There's some things that we'll focus on throughout it. Looking for total financial independence with the current level of life, working half days. There we go, Fernando. I know you're doing a good job buying some notes. That's awesome. All right. So, like I said, many people are looking for cash flow. They're looking for assets to add to their portfolio. They're looking to boost income or retirement. They're tired of being tired, right? Looking to put money to work from their 401k or IRAs or previous retirement account. Whatever your why is, we can help you do that with the note investing side of things. We've been doing it for years, and we're very proud of the fact of the success we and students have had. So we're here for it. So let's dive into the different types of notes in part 2 here to help you guys get rocking and rolling. All right. And one little thing we'll probably take 3 little breaks throughout here. So I'm gonna try to take a break, 10 to 15 minute break on the hour, just so you guys know. We'll probably have this split up into 3 to 4 shorter videos for you guys to watch. A little bit easier for me to process that way. But yeah, if you've got to take a break, we'll try to keep it to that break, a 15 to 20 minute break during the break. So it'll probably be at session 4, session 8, and then probably wrap up at the end of session 12. So there's a variety of types of notes that you guys can buy. Now, the first underlying type of debt or mortgage note that you can buy is institutional and non-institutional. Now, what does that mean? Okay, well, it's literally written right into it. Institutional debt is stuff that's originated by institutions, mortgage companies, banks, all right, REITs. That's institutional debt. It's gone through the proper channels for correct paperwork. It's all uniform. The loan applications, the underwriting, all that's written very, very well. And that's why we like to target banks, because they're originating a lot of institutional debt. Non-institutional debt is the owner finance stuff. If you're owner financing land or owner financing a property or doing a contract for deed, that's non-institutional debt. Okay, yes, there are some people that create quite a bit of non-institutional debt with owner finance, stuff like that. But for the majority, a lot of that non-institutional debt is from individuals like you, me, doing 1 or 2 deals. It's not a steady pipeline. It's definitely not a river of deal flow like we see on the institutional side. And that was one thing right off the bat that I realized. I could do all this work to chase non-institutional debt to get maybe 1 or 2 deals from a potential borrower who's going to be picky, doesn't understand it. Or I can do a little bit more smarter work to get the institutional debt sent to me, where they're sending me lists, hundreds of deals on a pretty regular basis. And once I make right contact, they're motivated a lot of times to move this stuff in different parts, right? Sometimes they're more motivated, depending on the source, depending on the seller, what's going on with it. So you're still going to deal with both sides, and some people are more motivated than not, but I would rather deal with a deal flow that's easier to get to, right? And I'm going up the chain and be dealing with the direct seller, not with somebody who's so emotional because it's their home, or the owner financed the property and now they're having to foreclose or whatever it might be. Okay. And out of that, you're going to see residential loans, first liens and first liens that are performing, people who are paying on time. That's what performing stands for. First liens that are non-performing. It means exactly what it says. People have stopped paying. You're going to also see residential second liens or junior liens, performing and non-performing. I would be avoiding second liens right now like the plague. I don't buy seconds. I take that back. I'll buy a second every once in a while if it's behind my first. But being in the first lien, I'm in the driver's position. In the second lien, yes, they're often cheaper than buying first, but they're overvalued right now. And with the market's expected to depreciate 10 to 20% or more, depending on where you're located over the next 12 to 24 months, I wouldn't buy a second at all. With appreciation, they're over encumbered. They're just not as safe and secure as being in the first lien position. They're riskier aspect of things, and they're not cheap like they used to be. Back 10, 15 years ago, you could buy a lot of seconds for like pennies on the dollars. That's not the case anymore. Okay. Not the case anymore. It's much easier to raise capital being in the first lien position than in the second lien position. Not trying to piss anybody off. Yeah, you could buy a loan, a first, second loan, and make a huge ROI. But if you got to wait 3 to 5 years to do it, whereas I like being in the first lien position where I know something's going to happen. The only time it's going to take 3 years is if I'm buying in New York City where I have to foreclose and go from there. You can also buy commercial paper that's institutional, but it's performing. Commercial paper that's also non-performing. That's a big market right now, and it's different asset class by asset class. Okay. Um, and then you also have owner finance notes, like we talked about, that are performing or non-performing. That's non-institutional debt that you could buy. We also see contract for deeds on lower valued assets where sellers are selling these on terms, but the deed stays in place and the borrower does not get the deed transferred to them until the contract is paid off. And these have been pretty good deals for us. Also, the years we've bought hundreds and hundreds of contract for deeds. Don't see as many anymore because of obviously property appreciation going up, but you still see some that are available that have been around for a while. Okay. Now, here's the thing, if people tell you that there's no deal flow out there, they're not marketing. Okay. There's 80 million some odd houses with mortgages on them, and we're at about a 3 to 4% default rate. That's millions of people in default. That's not counting the amount of mortgages out there that we don't know about. That's just on the residential side, right? Commercial side obviously is in a bloodbath right now in a lot of cases, a lot of assets. So keep that in mind. Plenty of deal flow. You can also look at, some people will do lease options and sell it as a paper. I don't really play in the lease option space. Um, I don't want to deal with toilets, tents, and trash outs, and that's why I kind of avoid that aspect of things. Now, if I'm doing a contract for deed, well, some states will identify those more as a rental or a tenant where you can evict faster in foreclosure. I'm not responsible for property management and contract for deed. Okay, that's a nice thing, a big difference between those two. Okay, now where should you focus? But I mean it is kind of the niche, not the states. We'll get to states a little bit later on. Okay. And we always have people that come from two places. They either want cash flow or they want the property. All right. Now, the thing when it comes to what you should focus on, especially in today's world, is focusing on cash flow. If you're into the note space just to take back more real estate or more property in a specific area, you're kind of missing the boat. Okay. Yes, will you take some property back? Yes, you will. Are you going to target vacant properties that you can foreclose on and maybe take back? You could do that. Here's the thing about the biggest bang for the buck in the note industry is buying non-performing notes and then keep rehabbing the borrower, not the property. If you're getting the notes to try to buy property, you're 6, 12, even maybe 24 months from owning that property. And if you buy the note and it's occupied, you could be within cash flow in 60 to 90 days, if not sooner, if you just work with a borrower in some sort of fashion. If it makes sense, there are some notes that we buy that we know we're going to foreclose right off the bat. Borrower's deceased, passed on. You're not getting him or her to start paying on time again. All right. We know that we're going to foreclose, especially on a lot of reverse mortgages that we've bought. Okay. But if it's occupied and the borrower has showed some sort of trying to do a payment plan, and you're buying that note at a cheap enough price that it makes sense for you to keep them in and make a double-digit return, why not? As long as they're bringing some skin in the game and stuff like that. But if somebody hasn't paid in 5+ years or hasn't paid since before COVID, that's a foreclosure. And sometimes that's going to make sense. And yes, we've bought occupied assets we knew we were going to foreclose on because the borrower was a deadbeat. Okay. But you should always look at your return on investment. Okay. Another thing is looking at what states you're buying in or the asset class that you're chasing. Is there inventory in that? A lot of people want to chase multifamily loans right now. Oh, I want to buy 100 and 200 unit loans. I want to buy it by buying the mortgage. Well, guess what, ladies and gentlemen? Banks aren't selling the mortgages on those Class A, Class B apartments at a discount. They're overpriced. We know that, and they're looking to take that back and hold for a while. Yes, you can find multifamily loans below 100, and there's some opportunity there. But I'm a bigger player because I don't want to own the real estate. I want to be in the note space. Okay. And of course, that's why I say look at pricing. Does it make sense for what you're trying to buy? Where you're buying? Buying in California, it doesn't make any sense. Okay. Buying in, Ohio, Michigan, Indiana makes sense based on things and pricing. Okay. And then the time. How many hours per week do you have to put to this? Now, we know a few folks are working full time here, and that's great. You don't need to create another job out of this. You don't need to work 40, 50 hours as a note investor unless you want to. Okay. But most folks start off at 5 to 10 hours a week, getting the ball rocking and rolling, and then evolve depending on where their business takes them. Okay. One of the great things we have is a great video showing you how to make 6 figures in the next 12 months. And so you can go to this bit.ly/100K in 22. This is a couple years old, but we do it every year. Check it out, making 6 figures as a note investor on a YouTube channel. and it's a great video to kind of give you an idea of buying. Hey, if you were to buy one note at about $400 per month, very easily turn that into a six-figure annual income coming in on autopilot. Okay. Now, one of the biggest things that people don't realize is that foreclosure timeframes will change how you take these properties back. Okay. And it's different in every state. Every state's a little bit different. You've got judicial foreclosures. These are foreclosures you actually have to go through the state. All right. There are longer timeframes in the process. Cost for a judicial foreclosure is going to be $3,500 plus because you got to pay an attorney to show up to court. All right. Florida, South Carolina, New York, New Jersey. All right. Those are judicial foreclosure time states. All right. California has a judicial and a non-judicial foreclosure process. Primarily that are states east of the Mississippi are primarily, a lot of them are judicial foreclosures in a lot of cases. Now you do have some that are non-judicial, like Georgia, North Carolina, Virginia. Those are some non-judicial foreclosures, a little bit faster, but it's going to cost you a little bit longer. And you could usually in a lot of cases, depending if when you're buying the notes, if they haven't started the foreclosure process, you should get it a little bit cheaper price because you've got to go through the foreclosure process. Non-judicial foreclosures, these are where people like, oh, I just want to buy non-judicial states because they're fast foreclosure states. Well, that's great. Yes, they're shorter time frames, like 21 days here in Texas to like 120 days in Nashville or Tennessee. Less expensive to foreclose, like $1,000 to $2,000. A lot of those states are west of the Mississippi. They're non-judicial, but guess what? They're going to have a higher price point because they can move faster. So banks know that. Lenders know that, and they're going to sell it. So I always tell people pick 3 to 5 states to start off with. Make sure you're picking, one judicial, 2 non-judicial, or whatever your mixture is. Okay. If you're in California, I wouldn't waste your time there. I'd buy outside. I live in Texas. I love Texas. Don't get me wrong. I buy stuff in Austin, buy stuff in Dallas, Houston, stuff like that. But Texas is not one of my top 5 states. Now, if I get something, there's a cherry on top. All right. But I see a bigger bang for buck by chasing stuff in Ohio, Michigan, Indiana. All right. Oklahoma, Georgia, the Carolinas. Um, those are some things. Florida is a judicial state, and they're getting hit pretty hard. There's still opportunities there. And I think there's going to be a lot more opportunity, especially in southern Florida, over the next couple of years as values drop and the markets have a tendency to kind of crash in a lot of cases. But we'll talk about that later on. Licensing requirements is always a big question I get for people. Do I need a license to buy notes? And the answer is yes or no. Depends on the state. Now, the biggest thing that will help you right off the bat, and everybody should do this. If you buy a note, make sure it's being serviced by a third-party servicing company like Allied Servicing or Covey Financial or worst case FCI or Madison. Okay, because if the state you're buying requires a license, usually it's a debt collector's license, and most of the states that require that, the get out of jail card is having your third-party servicer do that for you, and that's great. It's going to cost you $35 to $95 a month per loan, 35 for performing, maybe a little bit less. 95 for non-performing plus any other fees on top of that. But it's with a third-party servicer who's sending out statements and collecting on your behalf and not violating any state laws. And a few other states out there require you to have additional licensing. They may have you separate license for that in separate fees. Like Illinois wants you to pay the state was it $750 to be a debt collector on top of a servicing company. It's $750 for 2 years. It's just something you pay. Some states like Maryland are now requiring you to have a mortgage broker's license to buy in that state. Massachusetts wants to do that. Georgia wants you to have a mortgage broker's license to collect in that state. If you're buying second liens in Ohio, we have a separate license. So don't sweat about this. That's not everywhere. You're not going to be licensed in every state. Not every servicer is going to be licensed in every state. You can get around a lot of these licenses as well. But hey, you're either not going to be buying that state. Like I'm not buying in Washington State or Oregon because they require a separate license. It just doesn't make sense to buy there. It's too overpriced. So don't worry about it. Okay. Things will come and go. Things will license to change and just evolve with it. We're probably going to end up doing a couple episodes here of the Note Closer Show on licensing requirements, what states will allow you to get away with what over the next few weeks. Especially, we're coming up on 1,000 episodes, so we'll probably do an episode like 1,001, 1,002 is what I'm thinking about. Anyway, and like I said, some states do require you to be a licensed mortgage broker. Like Georgia requires that. But the great thing about it is if you use your self-directed IRA and buying your IRA, you can get around that requirement. And what we do also, if we're going to buy something in Georgia, we just partner with somebody who is already a licensed mortgage broker in that state and pay them 10% of our fees or profit to offset that licensing cost. Now, always talk with your loan servicing companies. Laws change. They'll notify you when you need to do that. When you're starting off as a new note investor, you're probably primarily going to be loading your notes with probably either Allied Servicing out of Washington State, Madison Management, FCI Exchange, Land Home Financial, or a few others. If you're just investing in one particular state, there are servicing companies that just focus on one particular state. Okay. Moving on, but don't let licensing scare you. All right. I'm gonna go get licensed every state. That just doesn't make any sense. Okay. Now, what is available in today's market? This is an important thing. Well, reperforming notes are available in today's market. Stuff that was once non-performing, that investors like you and me bought at a big discount when it was non-performing, worked with the borrower for a period of time and got them back on track, making payments for 6 to 12 months or longer. Now we are willing to sell that note at a higher price than we bought it for, but still at a significant discount. And if you're looking for passive investments, this is still a great way for you to buy a note and get a double-digit return usually on a reperforming note. Non-performing notes, we know that's buying non-performing and then going through the workout process, taking them back on track, or going through the foreclosure process or cash for keys to give that money to the borrower to let them walk. You take the property back. Of course, contract for deeds are available in states or on lower valued properties. Like I say, some states treat them as a mortgage, so you have to foreclose, like Florida. Other states treat it as a tenant relationship, so you can evict. So I like contract for deeds in Indiana if the property holds, because I can evict in 14 days versus have to go through a 9-month foreclosure process. So there's some pros and cons to contract for deeds on a state-by-state level. Alabama, I'll buy contract for deeds in Alabama all day long because I can evict in 30 days or less. Whereas if it's a mortgage, there's a 1-year redemption period in Alabama. Okay. So I got to hold that property after I foreclose it for a year before I can turn around and sell. Not in a contract for deed. Non-performing commercial notes of all asset classes. You're seeing stuff out there. It's all about location, state by state when it comes to stuff. So if you're looking like, oh, I'm here to learn about self-storage notes or multifamily notes, we're going to spend most of the time primarily on the residential side on how to find this, how to fund this. When you're buying commercial notes, you've got to know the cash flows, the cap rates, what's going on with the rent, stuff like that. And often you have to be a Sherlock Holmes when it comes to finding this stuff. Not difficult, but we're not going to spend today on that stuff. Okay. You do see notes on platforms. There's some note platforms we'll talk about a little bit later on, and you'll see notes that have stuck around for a year, 6 months. Really, anything that's longer than 60 days on a note sales platform tells me it's got some issues or they're overpricing it. We see that on some of the most ones you probably have heard of the most. It's a lot of crap. Okay, just a lot of shit that's not moving. No offense. Maybe a little offense given, because there's plenty of opportunities out there for you to go find stuff directly if you'll just learn how to market. And we'll share some of those tools a little bit for you. Okay. You can also target newly originated owner finance notes. There's a lot of that stuff on some of these platforms where they made 1 monthly payment or 2 monthly payments. I don't buy that stuff. If I'm going to buy an owner finance note, I want something that's going to be seasoned for 6 to 12 months. Borrower put a lump sum down, and the seller of the note didn't over exaggerate the value of the property over what it really is. And you see that happening quite a bit sometimes out there. Okay. Like I mentioned before, wearing the different hats, you've got to have a banker's mindset versus a fix and flip mindset. You are buying the note, not the property. Yes, the property is a collateral for the note that you're buying, but you're not going to necessarily end up with the property always. Okay, you've got to go through the process of either getting a cash for keys or deed in lieu from the borrower or foreclosing and it not selling at the auction. Biggest mistake I made early on in my note investing business was the first 2 years, I tried to foreclose on everything. I was foreclosing. Well, that would take 6 to 12 to 18 months in a lot of cases. I was buying a lot of stuff in God's waiting room, Florida. So it would take time to drag it out, and I'm paying attorney fees and servicing costs and no income coming in. When I look back at it, I could have probably modified it or did some sort of workout plan with the borrowers and made a whole lot more money immediately on the cash flow side, turned around and sold the note in 12 to 24 months as a reperforming and made more money and had a higher yield and more cash flow coming in than trying to foreclose to take the property back. Okay. Quit chasing equity. The equity does not belong to you, ladies and gentlemen. I know this is difficult because we as real estate investors, we're in the fact that chasing a distressed property that's got equity or getting a property that's no mortgage on it, get the homeowners to owner finance the property to us in a sort of fashion, right? Or distressed property, we needle down the offering to a homeowner in distress because it needs all this work done and we need to be compensated for it. And I agree to that. If you're buying the property, you do. But if you're buying the note, buy the note. I don't bid on the equity because I don't count the equity coming back to me. Sometimes it does, but a lot of times it will not. And you want to streamline your product's focus. Don't be a jack of all trades. Focus on, hey, I'm buying in these 2 to 3 states, and these are the asset classes I'm buying. I'm targeting on single family homes, 3 bedroom, 1 bath, 3 bedroom, 2 bath that are built after 1960 that are valued between $100,000 and $250,000 with mortgage payments going to be at least $500 or greater a month for me. Okay. Streamlining what you're focused on is going to also save you a lot of headaches chasing these one-off squirrel deals. All right. Streamline your products focus. You're not buying everything. When somebody calls me up and says, hey, I buy everything in the note space. No, you don't. You're a broker. I'm not going to sell this to a broker. Buy for your own portfolio first. Okay. Like I said, avoid the shiny object squirrel syndrome. You'll be a lot happier out there. You get a tape in from a bank and the lender, there's not anything on it. It's all junk or old shit. It's okay to say, hey, there's nothing on this tape that I want right now and move on. Okay. You're going to want to have 3 exit strategies at least per asset for the most part, especially if it's occupied. If it's vacant and the borrower's dead, you're not getting that borrower back on track. Okay. But cash flow should be your number one priority, especially if it's occupied. Okay. And then taking back the real estate and doing a fix and flip is secondary strategy and going from there. Okay. Questions about that before we move on to the different types of note sellers that are out there for you guys? If you're joining us late, good morning. Glad to have you here. We're going to have a fun day today. All right. And yeah, we're going to rock through this, guys. You may need to go back and listen to this at half speed because I do speak a lot and I do throw a lot of water out like a water hydrant. But we're here to help you guys take advantage of what's going on in the market. There's never been a better time to be a note investor out there right now. I mean, well, I take that back. Good time was between 2008 and 2014. And while we don't have prices like we did back then, it's still phenomenal prices, still plenty of inventory out there for you guys to dive into. Okay. Let's talk about note sellers. Where can I find these deals? Well, places to find note sellers are pretty easy. Banks. Guess what? They're originating. They got stuff for sale. And every quarter they file a quarterly report with the FDIC to keep their FDIC insurance to tell you exactly what's on their portfolio. Banks are literally disclosing what they have in non-performing stuff. Percentages, ratios, values. There's about 100 big banks out there that are upside down technically based on what they have on their books. Okay. You can also go to lending institutions, mortgage companies that are originating loans and then holding them for their portfolio and selling them off. There are mortgage bankers who are originating stuff as well locally for bigger banks that have taken stuff back. You can also look at servicing companies. There's about 190 different servicing companies in just in the United States. Sorry. In Texas, there's about 100 servicing companies. Nationwide, there's a couple hundred, 300-400 out there, and they've all got notes. And many of them have non-performing stuff that you can buy. Just got to reach out to their business development person. You go to note conferences and conventions, servicing companies, conventions, stuff like that to find sellers there or people who have notes. You can go to LinkedIn, which is one of my favorite places, easiest way for you all to get started. We'll talk about that in a minute. Private sellers, investors like you and me, or you, if you want to really bang your head against the wall, you can send out letters to people who have originated a one-off note too. County clerk, one of my second favorite ways to do it is going there and tracking an assignment of mortgage. If a mortgage is bought and sold, there's an assignment of mortgage that's been recorded at transfers at note sale. It doesn't transfer the deed, but the assignment of mortgage. If you go do a search now for assignments and look for assignment of mortgages, you'll find lenders, institutions selling paper in every county across the country. If you like 3 to 5 states, go to the biggest counties in those 3 to 5 states and do an assignment of mortgage search. You'll be blown away. Okay. Of course, you can look at foreclosure lists. Those are distressed mortgages. Those are non-performing notes too. Reach out directly to the lender on that, or even the attorney to see if you can get the introduction to the seller or the owner of that note through a backdoor relationship. Okay. We did a longer finding deals webinar. I probably need to update this a little bit. It's still one of our most popular podcast episodes every month out there. But finding note deals in 2025 is not difficult to do. I actually did a little rant on it on an episode yesterday about it, how people all can't find notes. Well, if you can't find notes because you're you're not marketing. That's period. No questions asked. You're not spending time marketing, finding deals. Posting in a Facebook group of note investors that you buy, you're looking for notes to sell. Guess what? Is not an effective way to do it. Go out and find something. Actually, that's a good post. I'll probably piss them off. But I mentioned earlier, just in the last slide there, about LinkedIn being one of my favorite ways to find notes. And that's because you can literally go to LinkedIn and type in the different departments that are labeled at different banks for the right relationship, or find the people that handle the note sales. You can go type in right now, special assets department or special asset managers. That's for your largest institutions out there. That's the department that handles the note sales. You're not going to call the bank and talk to customer service or loss mitigation. You're going to want to talk to somebody in the special assets department. Okay. Secondary marketing department, banks, REITs, this is what they title the department that handles the note sales. Special assets manager, secondary marketing manager. Okay. For REITs and some insurance companies, they have something called a whole loan sales department, whole loan traders. You can actually type that into whole loan trader into LinkedIn, and you'll find thousands of people that have that job across the country. That's a good starting point. For the smaller banks, the regional banks, chief credit risk officer is often the person. Now, I don't target banks that have less than 5 branches. They're just too small. That's not mean they won't sell you enough, but they just can't take a big discount like you would like to get. Look, we're as real estate investors. I'm a note investor. It means I'm a real estate investor. I want a discount. So I want to target that small to regional bank side, or that the private investor who's doing this on a regular basis, or the well, what am I saying? The mortgage company and mortgage banker. That's where I'm going to build the most amount of deal flow coming in. Now, you can also go out there and type in note seller, note fund, as well as another way to find sellers of notes for you as well. Okay. Now, there are some websites out there to help you find notes. You can go to laneguide.com. Laneguide.com has been around for 40 plus years. Some people think it's archaic. Okay. But I can go to laneguide.com and pull up a huge list of note sellers and asset managers in just a few minutes for $165 a year. And it's oftentimes going to give me an email or phone number that I can reach out to. Bauer Financial. Bauer Financial tracks the quarterly reports that banks and credit unions file with their FDIC, and you can actually go buy a Excel spreadsheet that outlines what kind of, like I buy a list for banks that have 5 or more branches, and it tells me exactly how much their portfolio is underwater, how much is in distress, how much is over 90 days in default, how much is 30 to 89 days, which is coming down the core portfolio. So Bauer Financial, well worth it as well. The FDIC.gov, if you want to go there and look at individually, you can look at every bank's quarterly report. They also will report asset sales on the FDIC.gov website on those sales. I like the Texas Savings and Mortgage Lending Department because I can go there, buy a list of mortgage, or not buy a list, get a free list of every licensed mortgage banker, service company in the state of Texas, and they send that list with contact information that I can do a drip marketing campaign out to. It's a phenomenal tool for me. You can also go to other states and look at their licensing websites, like Florida or California, and go request a list of all mortgage bankers there or servicing companies, and they'll send you the contact list. It's a great way to find notes. Okay. Scotsman Guide has been okay in the past. They've changed up some things, but you can still go and request. I like it for commercial notes, because you can go to Scotsman Guide, put in a lending scenario on the type of asset class you're looking, and it'll give you a list of lenders who would lend on that asset class. Most of those lenders are going to be portfolio lenders that when they originate something, they hold on to it, and they may have non-performing notes that you can buy in that asset class. So Scotsman is pretty much just on the commercial side of things. Now, there are some platforms, some websites out there that list stuff, like you go to paperstack.com, and they're okay. You go to Watermark Exchange, which really doesn't have much anymore. SN Servicing, they're a servicing company, but if you go to their website and look for the investor tab, you can get signed up as a note buyer there, and they often will send stuff out. Debexpert.com, and they've got, usually it's a recycled list of what's on PaperStack, Watermark Exchange, or JKP. Fixednotes.com will have some stuff, but primarily it's seconds and thirds, not a lot of great first liens. Exchange.notes is more of the commercial side. This is started by a couple buddies of mine, Michael and Andre, out of Miami originally. They used to work for auction.com, another website you can go to, and they started this trading platform working through notes. And like I said, auction.com or 10x, which, well, it's now affiliated with LoopNet. I think they just bought LoopNet, or LoopNet just bought their 10x side. And you can find some commercial notes on there as well. Mission Capital Advisors, Note Trader Exchange has some stuff supposedly. and DebtX, not DebtX, but DebtX also lists stuff that you can take a look at. Usually DebtX stuff is going to be more institutional stuff, larger portfolios for you. Okay. But those are all platforms. I still like the LinkedIn and making connection aspect and dialing for dollars aspect, a much more effective way to get portfolios into me on a regular basis. We've been doing it for years. We still do an email blast campaign to over 5,000 asset managers about once a month, and it still sends us getting deals sent to us. Okay. All right, let's move on. Session number 4, note scripts. How are we doing in time? We're doing great. All right. What to say, what not to say when you're talking to asset managers. Okay. Because when you're reaching out to banks or note sellers, there's things you want to say and things you do not want to say. Okay. You're going to have a basic elevator pitch. You've heard this before. Role play a little bit. What do you have on your books that you're looking to move this month or quarter? Okay. Simple. Hey, are you the right person that handles note sales at your bank? Great. What do you have in your books that you're looking to get rid of this quarter? I'm looking for my own portfolio. You got to understand that. Never say, oh, I represent a seller or I'm a buyer's rep or a seller's rep. Ugh. Vomit in the mouth. They will hang up on you because they've heard it before. Don't say you're a broker. Don't say that either. I'm looking for my own portfolio. We're looking for something with some hair on it. Hair means hairy. Okay. Means it's non-performing. It's got some issues with it. Okay. Bigger discounts that way. We're looking to work it out with a homeowner. That's one of the things we always try to work it out with a homeowner if we can. If not, we'll move it on. Banks like to hear that for some reason. Okay. They'd much rather sell to you with the idea that you're going to try to work it out versus foreclosing because they can just go ahead and foreclose. And we're looking for stuff in these markets or states. Now, what I don't do, what I do say is I'm looking for stuff in most of the major markets. I'm looking for single family homes between 100 and half a million that I can buy in most of the major markets. I mean, we'll go up to $1 million on a single family asset in a few markets, but for the most part, your cookie cutter, bread and butter, steak and potatoes are going to be single family homes under that $500,000 value. Okay. Don't care how far behind they are. We'll look at them and work through it as well. Of course, it all depends on the value. If they ask you pricing, it's going to vary on where they're at in the foreclosure process and condition of property. So keep that in mind. Okay. Now, do not say these things. Okay. I have 20 million a month to buy. They will not believe you. I can't tell you how many people call me. Well, I got 20 million a month to buy. Well, no, you don't. You wouldn't be calling me. If you got 20 million to buy, you'd be dealing directly with some of the bigger funds. Okay. Don't say that. Or you represent a seller with 20 million. Or I'm looking for notes and REOs. How many of y'all thought that? Come on, be honest. We've all thought that. I'm looking for foreclosures and notes. Don't say that when you're contacting the banks, because if you say I'm looking for notes and REOs, they're going to just forward you to the REO department, which is a voicemail box that simply says call the listing agent or go to our website and look at the foreclosures. If you're looking for notes, be specific. You're not both parties, or you're not looking for both those. You're looking for notes. I'm looking for non-performing notes. Looking to speak to somebody in your special assets department or your secondary marketing department. Okay. And don't say I'm looking to broker or wholesale. They will blacklist you and not return your phone calls. I don't care if you are brokering or wholesaling. Don't tell them that. Banks are going to give you, 2 weeks, 30 days, 60 days to do your due diligence, go through it. So it's plenty of time for you to flip that note. You ain't got to tell them that. Do a double closing. Okay. Like I said before, don't say I represent a buyer. You are the buyer. I'm buying from my own portfolio. Okay. And like I said, don't say I'm looking for anything you got. No. Now you can say I'm looking for anything that's single family homes. Okay. Between that $100,000 and $500,000 range. And then here's the thing, a kiss of death. Don't say like, I know Greg, you're up in the Dallas market or Arlington. Say, I'm looking for just stuff just in Arlington. That doesn't make any sense. They're not going to waste their time. Okay. Or I'm only looking for stuff in the Austin zip code. Well, don't waste your time with that either. They're not going to do that. What you want the seller or the asset manager on the other side to do is make it real easy for them to send you a non-disclosure agreement from the sign and then for them just to download the spreadsheet and send it to you. That's what you want. Okay. Previously, back in my days of getting started when I was traveling the country, I would walk into like Regions Bank, and Regions Bank would put me with their asset manager, and their asset manager had a big 3-inch 3-ring binder, and it was like 2 pages of every commercial asset I could cherry pick from. Okay. I walked into the Bank of Shamrock in Naples, Florida one time, and they sent me back into a conference room with a big boardroom, and it was basically stacked to the ceiling with loan files. Okay. A lot of these asset managers may not be the smartest when it comes to marketing. So you want to keep it simple. The less work that they have to do to send you something, the better. You can be the person that looks through the spreadsheet to find that one state. If you're still going to bang your head and try to do that, Focus on 3 to 5 states. Focus on just getting the list and then filtering through the list to tell them what you like. Of course, if they send you something, there's nothing on the list that you want, be respectful. Say, hey, there's nothing on the list right now. Can I follow up with you in a month? Or when do you repopulate the list? And I'll follow up with you then. Okay. Now, contacting the bankers. Best time to email bankers and phone call. We'll talk about phone calls in a second. I know some of you are going to be very scared of that 1,000-pound telephone, but it's still one of the best things to do. But emailing, especially those that are working full time, if you get a list, and it's not too hard to pull a list of emails of different bankers and different contacts for it. The best time to email bankers is Tuesday, Wednesday, or Thursday. Surprise, surprise. That's the best time to send an email out anyway. It's Tuesday, Wednesday, or Thursday. Okay. Highest open rates is Wednesday. But the reason we talk about Tuesday is if you send it at a Tuesday morning between 10 a.m. and 3 p.m., that's the best time to send it, is you want to give it 48 hours. And once you send it, you'll probably get a 10 to 20% open rate the first time out. Bravo. That's a good starting point. Okay. Depending on how big your list is, 10 to 20% is pretty normal. Okay. Not everybody's sitting by waiting for you to send them an email. Okay. And one of the things that you do is you never want to send it from an info at or contact us at or sales at. You always want it to come from a personal email like scott@weclosenotes.com. Okay. Get you a professional email. Simple. All right. Quit using your AOL website or your Hotmail account. Okay. Or your Yahoo account. You send it from a professional email, you'll get a 10 to 20% open rate. Banks have the biggest spam filters out there, so you want to be primarily text, very little media, no socials on it, except maybe your LinkedIn profile, okay? Now, you want to send a second email, but you want to send that second email 48 hours later. So if you send it Tuesday morning, send that second email Thursday afternoon, okay? You'll get a second email, get open up another 5 to 8% open rate. And then guess what? Do it again. Send a third email another 48 business hours later. That would be like on a Tuesday afternoon. Tuesday morning, you'll see a 1 to 4% open rate. But sending a third email isn't like that person's going to get 3 emails. We're going to send it to the people that didn't open the email the first time around. So if you're using a CRM, you should be able to, like if I send an email out to my asset managers, it goes out to 5,000 and 1,000 will open the first time. Then I'm only going to send that second email to the 4,000 that didn't. Okay. And if only 3,500 people, I've only 500 open the second one, that leaves 3,500. I'm going to send that third email to the 3,500. Why? Because I want to build that hot list of first that people are going to open it. And then I can follow up with those people on LinkedIn or a phone call and stuff like that as well over the month. And it's still a very effective way to do it. Like I said, guys, follow up, follow up, follow up. 80% of sales are made after the 5th contact. This is the biggest travesty of real estate investors out there, and note investors are some of the worst. They never follow up. They might send one email and then never follow up. They might make one LinkedIn connection, never follow up. They might send, leave a voice message and never follow up. I get it. It's tough and difficult to do, but it's 2025. There are things like LinkedIn and things you can help automate this to kind of do the outreach. Now, the best time to pick up the phone and call asset managers and bankers is the same time. Tuesday, Wednesday, Thursday, same time, 10 to noon and 2 to 5, a little bit different because they're usually out to lunch from 10 to 2 or noon to 2. Their time, not your time. So you have to coordinate what your schedule looks like. If you're on the East Coast, you're probably calling in the afternoon, which would be early afternoon on the West Coast. If you're on the West Coast, you probably need to call in the mornings of your time to get people before you go. All right. Expect to leave a lot of voice messages. These days, if you leave a voice message, it may be voice to text. That's a great thing to have. Sending an email blast out and you get out of office responses. That's a great thing too, because you look at the out of office responses, they'll tell you who to contact when they're gone. But call, speak slowly, clearly, have your elevator pitch available, and repeat your phone number twice or your email twice. Part of the reason I got an easy email like scott@weclosenotes.com, that's pretty easy to remember. So for some of you that have these long, difficult names to pronounce, so it's Megan instead of Megan, you're going to run into issues. So try to keep it as simple as for people to respond to you. That's one of the most important things. Keep it simple, people. Okay. And smile while you dial. Okay. And we've always said there's a ratio that we see And this is still about the same. Make 50 phone calls. You probably talk to 14 people. You probably end up getting somewhere around 4 NDAs to sign. That'll lead to probably one tape, one asset, or stuff like that. A tape is an asset, right? Depends on who you're targeting, but it's going to lead to getting stuff in if you make that. And you can make 50 phone calls in a day and in an afternoon. Done it plenty of times. We got plenty of videos of me making phone calls and dialing for dollars. Okay. Like I said, expect to follow up, follow up, follow up, follow up, send an email, make a phone call, connect on LinkedIn. Okay. Send a message on LinkedIn. Hey, just trying to reach you the right person. Can I give you a phone call to talk with you? And rinse and repeat, 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 repeat. Okay. 80% of sales are made after the fifth contact. This is going to lead to anything. This is so much more effective than sending out 5 letters. Okay. A lot of you guys are dropping tons of money on direct mail campaigns, postcards, and you're getting a very slow response. This is more of an effective response thing than sending out postcards and letters. And you're not going to send letters and postcards to asset managers and banks. That's not going to happen. But this is a great way to do it. And you can automate the LinkedIn follow-up too in some cases. I'll show you that in our class. But the great thing is when you talk to somebody, put them on your hot list. Put them on the list that you can just send a quick email to once a month. Hey, just touching base with you. I've got plenty of those asset managers over the years, but I still drip market my green email, as they call it, out to my asset managers on a monthly basis. Okay. And there is a video on our YouTube channel that you can see for me calling asset managers for 4 hours. Calling asset managers. It's a couple years old, but still effective and still walks you through what we do. Okay. Expect to follow up, follow up. It's one of the biggest keys to in any niche is in the follow-up process of closing things. Okay. So if you understand that on the upside, on the front end, you won't get burnt out. People will make 10 phone calls and give up, or they make 50 phone calls once and give up. That's not the effective way of doing any type of business. Follow up, follow up, follow up. Okay. Our upcoming workshop we refer to is called notebuyingfordummies.com. It's July 25th through the 27th. We spend a full day on that Friday. It's a Friday through Sunday going through how we find deals. We'll do a deeper dive into exactly what we say on LinkedIn. There's sample emails you can see of what we send out. You can actually see how we create our call list, how we pull lists of asset managers off of Lane Guide, how we leverage the mortgage, Texas mortgage and savings lists. All that good stuff is just focused on day one. And that's the great thing that why we always run a 100% money back guarantee. So if at the end of day one you don't like what we've talked about, just let me know and we'll give you your money back. You can't take the online and watch the replay and do that, but attend in person there on the Zoom call with me. Show up there at the end of the day when you don't like what we talk about, we'll refund your money back, no questions asked. Okay. And then we also have a monthly membership that's $97 a month. That's called noteumbrella.com. That includes a ticket to the virtual workshop, which is usually $997. Ticket to our weekends, all our bank trainings, all our calling banks masterclass, our wholesaling masterclass, our due diligence masterclass. It also includes to some of our new AI software that we're using to help you guys learn much more effectively. Our Vulcan MyMail with our videos, along with our soon to be released Scott Clone. That's right. You'll be able to go on to a website and ask me questions, and I'll respond back via text, phone call, or video to you. So I'm really, really excited about that. We're literally uploading everything to literally taking my brain and everything we put out there and put it in AI to help you guys learn more effectively for you. And that will be included for just $97 a month. So you can get signed up for that at noteumbrella.com. We just ask you to be involved in that for 6 months. That's the one requirement because we do pack so much stuff into it. But we also, great thing about that, if you're looking for notes and note tapes, we upload note tapes into our online portal for you guys to take a look at and evaluate and go from there. Okay. So let's take a quick, let's take a quick 15-minute break. Let you get up, stretch, fresh cup of coffee. Come on back for our session 5 on marketing and prices. Okay. All right. So I'll give you guys a couple more minutes, but Greg asked a great question here during the break. Why would an institution sell the note if it's about to go to foreclosure? Wouldn't they be made whole afterwards and not have to sell to you at a discount? Great question. The answer is there's no guarantee of them selling at the foreclosure auction. How many times have you been to a foreclosure auction and see them bid at a price that doesn't make any sense, and now they have to take the asset back, go through eviction, go through fixing up the property with licensed and bonded contractors and all that stuff, and then turn around and try to sell the property, especially in states that have longer foreclosure process. Now, here in Texas, Greg, I think here in Arlington, DFW area, where the Cowboys are, go Cowboys. Hopefully have a good year. Yes, they would probably just go ahead and take it to the auction. In most states, if they're at like it's the week before the auction, yeah, they're probably not going to sell the note to you at a discount. It's 30 days before the auction, they may not sell the note for you. I still had them sell it to me, and that's all comes down to what you offering. They know what they're into it for. They know what's going on with the assets. So that's the reason banks will sell you distressed debt, is because if they can get 60 cents on the dollar, 70 cents on the dollar, because that's what it really needs to be for us to make money on it, right? They can get this now and then go out and lend that money out 10, 15, 20 times like banks do. It's worth them to do that, versus maybe they sell it at auction, or if the borrower files bankruptcy and delays things, that they won't get it. So that's why banks sell notes. Okay. Now, you're not going to buy from Bank of America, Chase, Citi, Wells Fargo, because they want to sell a $50 million tranche. All right. But plenty of lending institutions. Now, Texas is the exception because it is such a fast foreclosure state, but you still see stuff in Texas. That's why I say, hey, look at 3 to 5 states. If I see something in Texas makes sense, it's a cherry on top of my portfolio. Right. But yeah, they would be maybe may hold afterwards, but no guarantee to it in a lot of cases. Now, if there's a ton of equity, yeah, property's worth 400, they're only 200,000. You're not going to bid at 70 cents on the dollar for that. You'd probably have to bid at 80 cents on the dollar, maybe 90 cents of the legal balance, not the value. Okay, so like we just had a deal recently where the property's worth over 400, borrower owed less than 200, right? They bought it for like 170, which is like 90 cents on the dollar, but then we gave the borrower some cash for keys to walk. We gave him some money to do a deed in lieu and give him a little bit of that equity to walk, and we still made money on it. Okay. So that's the reason. It all depends on the state it's in and where it's at in the foreclosure time frame. If it's in Florida and they're starting to foreclosure and that takes a year process and it's an area that's really distressed, they probably will unload some stuff definitely to you as well. Okay. But that's a really great question. We get that question all the time. It's one of the most important questions. Why would a bank sell a non-performing note when they can go and foreclose? Well, some they will, some they won't. Okay. It also depends on where that portfolio is with the bank too. If they've got a lot of stuff on their books, remember they've got to keep reserves for every non-performing note they have. So if they can offload that non-performing note, it frees up reserves they can put to lending and doing other things. All right. So that's one of the most important things to keep in mind. It all depends on the bank. If it's a one-off little bank, they're not going to sell it at a discount because they can't afford to take the loss. Bigger regional banks can offset that loss by rinse and repeating the money on a regular basis and freeing up reserves. All right, let's dive into session 5 here, markets and pricing. Okay. Now, you've got to keep this in mind that note markets can vary based on a lot of things like we just mentioned. The popularity of a market, Miami, Florida is much more popular than Miami, Ohio. The values going on, once again, Miami, Florida is a lot more expensive than Miami, Ohio. Foreclosure timeframes, Austin, Texas is a lot faster to foreclose than Austin, Minnesota. Austin, Minnesota, you can foreclose not too bad, about 6 months a year, but you've got a 1-year redemption period after that. So keep that in mind. Okay. And of course, the population. You want to, when you start off, stay in markets, stay in cities that have at least 50,000 people or more to begin with before you start dropping down below that. 25,000 might be the exception, or if you know of an area. I always talk about how I grew up in South Texas, a little small town called Ingleside, 10,000 people. Okay. Aransas Pass, like 5,000 people next door to it. Port Aransas, 2,500 people. Okay. But I would buy down there all day and every day because I know that market. I know the people. I have a team that I trust. I know people are moving there, stuff like that. Okay. The only exception to a smaller population, it's on the outskirts. Like one of my students, Phil Brodeur, is buying a note just outside of Anderson, Indiana. It's Middleton, Indiana. So it's a little small town of 3,500, but there's a lot of growth going on there, and a lot of people live and work in Anderson, live in Middleton. So it's a good deal. So keep that in mind. Don't buy rural for the most part. When you're starting off, let's keep it cookie cutter where there's plenty of people to buy, plenty of vendors to work with, plenty of realtors to do some stuff, and so you have some great the numbers. If you start buying notes and your BPOs and broker price opinions and CMAs come back and it's longer than 180 days in the market, that's probably not a good day, a good deal, unless you're going to get it at a substantial discount. Okay. And like I said, look at inventory. That's all important. Is there stuff there that you can actually buy? If not, like I'll give you an example. Like I'm in Austin, Texas. I don't see that much stuff in Austin, Texas. So I had to expand my market and understand 3 to 5 states to begin with. And that's what I did. Not that hard to do, ladies and gentlemen. There's a little tool called the Google on the internet that will help you identify opportunities or help you build a virtual team to help you out. Okay. Now, what's hot right now in the world of note investing? Obviously, the most expensive note markets are California, as always, Arizona right next to, although Arizona's got more distressed stuff than it has in a while. Texas, hook 'em horns. We're always one of the number one states out there. People looking to buy stuff here because there's a fast foreclosure and we're the friendliest state when it comes to lending. Okay. Nevada's not so bad. Obviously, Las Vegas and Reno are the two primary cities there that you'll do, but there's stuff there. A lot of people in California are buying in Arizona, Nevada, or Texas. And then Georgia. Georgia is always hot because it's fast foreclosures, but it's got that one tricky thing. You need to have a mortgage broker's license or use your self-directed IRA to buy the asset. Okay? Keep that in mind. Moving on. Anything on the West Coast, too? I don't like buying in Oregon, Washington State. There are some people that like that stuff up there. Just it's overpriced and not lender friendly. But you start looking at when we consider also on the West Coast, you also have Colorado, kind of considered West Coast, even though it's a mountain range. You know what I'm saying? Utah, Idaho, all that stuff in the bigger cities there is going to move pretty fast. It's also going to be the most expensive stuff for you. Okay, what's not? The least favorite markets are New York City because it takes 3 years to foreclose there. There's plenty of people that live in New York that want to buy there. They don't understand it. They make a lot of mistakes there. New Jersey takes you 2 years to foreclose, unless the one exception in New Jersey is if it's a vacant asset. Then it's a 6-month foreclosure time frame. So that's something to keep in mind, right? Kentucky's not because you need to have $1 million bond there if you're an institution, $500,000 if you're a private individual buying. Chicago and Cook County, horrible places to buy notes. Okay, unless you live there. If you live there, okay. But if you don't live there, the county, the judges are always going to side with the owner occupants or the tenants. It's just a horrible place to own real estate. And then also what's not is assets that are under 30,000 in fair market value. You got to keep that in mind. We've had a lot of appreciation over the years. And if an asset only worth 30,000, it's probably either rough or it's a shanty shack. Doesn't mean you want to buy it. Stay above 30, especially when you're starting. That does not. Like we've got some of our coaches who have bought small valued assets like $1,500, $2,000 for a note that's like under 20, and they did it as a learning curve. And that's not bad. They made some money on it. They got in, got out, and moved on. Okay. Also, what's not exciting is high equity note deals. That means where like the borrower owes the property's worth 500 and they only owe 200. You're not going to get that in a lot of cases unless you get creative. Okay. So keep it in mind. You're going to look for primarily underwater assets. Borrowers that owe more on the property than when it's worth. That's going to be the easiest for you to buy at a significant discount for you. Okay. Now, where do we see the most inventory currently right now? And hasn't changed that much. Ohio, Michigan, Indiana. All right, those 3 states, 3 of my favorites. Ohio's about a 9-month foreclosure. Michigan's like a 90-day foreclosure. Indiana's a 9-month. But you can evict in those states faster if it's contract for deeds. So I bought a lot of contract for deeds in those 3 states. But also they've seen a lot of growth, especially the bigger cities in Ohio. And yes, I buy in Michigan. I like the Wolverine state. Okay, sorry, Spartan state. I mean, Indiana, I like the Hoosier state. It's a great state. It's got a couple little tricky things on it, but it's not too difficult. Some of the city municipalities are harder to deal with. Anderson is a little difficult to deal with until you figure out how it works, and then it's not so bad. Illinois is a lot of stuff there. I would buy stuff outside of Cook County, but I would not buy anything in Chicago to save my life. I lost too much money in Chicago. Okay. Missouri, not a bad state to buy in. Florida, you see a lot of stuff hitting the stuff in Florida market right now, but you got to be careful of Florida. Okay. Florida is already on that teetered point where, like, the Wall Street Journal just came out. Cape Coral is the worst market in the country. Southwest Florida has been hit hard by hurricanes, but it was also hit hard by foreclosures years ago too. So there's an opportunity to come in here Maybe not right now, but we're getting pretty close to where I think they're going to sell a lot of that debt off at big discounts. You're going to have to deal with insurance, but if you can buy at the right price and work out some modification stuff like that, it may make sense to keep it going. And they're also, we're seeing as we have an aging population starting to pass, we're seeing more reverse mortgages hit the market as well that we can take a look at. Okay. So there's definitely some opportunity there in those markets. We've bought quite a few vacant reverse mortgages over the last few years. And that play is not a type of reinstatement or cash flow. That's basically a straight foreclosure replay. Okay. Foreclose, sell it at auction, or rehab it. Okay. And then also, if you like the commercial stuff, small balance commercial stuff, sub 5 million in value, there's a big gap in people buying stuff that's below 5 million. A lot of opportunity there for you to work stuff out. Okay. Pricing models. This is an important thing, aspect of it. It's kind of a guideline. It's one of the most important questions you can ask sellers when they send you a list. What's the pricing model? What do you want for this stuff? If they tell you par or par plus, just move on. It's not worth it. Par means they want the full balance. You're not going to make any money on a full balance. So don't buy scratch and dent loans, stuff that's newly originated. And so there's a lot of banks, oh, I want full payoff. Well, you're stupid. Okay. So non-performing negative equity, you're going to use a system called the stair-step method if they don't give you pricing. If they give you pricing on the spreadsheet, great. If they don't, they give you some sort of pricing guidelines, enter a column on the spreadsheet and run some formulas. But we'll show you the stair-step pricing model. Is not difficult to do. It's just meant to be a guide if they won't give you anything else, okay? Non-performing with where there's equity, where they owe less than the property's worth, you're probably going to need to come in 80 to 95% of either the UPB or the payoff or the legal amount, okay? Some of that will make sense. 20% below the legal payoff can be a nice sized chunk of change. 95% of the payoff isn't a good chunk of change unless you can get the borrower to walk away. And you can't talk to the borrower before owning the note. So it's not, I don't pursue a lot of those. I try to stay the 80% and go from there. And if you've seen me break down a tape, then you can see how I kind of structure the deals, structure the spreadsheet so you can find the best potential opportunities for you to make offers on. Contract for deeds, it's usually been in the past 30 to 60% or lesser of UPB or fair market value. Usually these days, you're probably going to need closer to that 80% of the UPB because a lot of these have increased to increase in values. So maybe they only owe 50K on a 100K. You probably need to be at 40,000 on a $50,000 note based on that. So that number's changed depending on where it's located. Okay. Junior liens, I don't talk about those. I don't waste my time on second liens. They're overpriced and there's a lot lack of inventory for a lot of cases, but the ones that are coming out just way overpriced and not worth it. Okay. And your commercial is going to vary by cap rates and asset classes. You're going to submit bids either as a percentage of UPB minus taxes owed. So I'll give you an example. We go back to this one where it was worth 100. They owe 50 on it. I'm making an offer at 40. Before I submit my offering at 40, I look at how much in back taxes. If there's $2,000 in back taxes owed, I'm going to reduce my offer of 40 to 30, 35 or 38, depending on how much, where they're at in the foreclosure process. If they're starting the foreclosure process, I'd probably be at 35 because I want to roll in the foreclosure costs in plus the taxes owed, because I may have to pay the taxes. So I want to deduct that from the price. If there's no taxes owed, then I would probably say, okay, instead of 40, I'd probably offer 35, 38, see what they would do. You know, because usually they're going to counter your back and then, okay, I can meet somewhere in the middle, be good. Okay. But you're just going to send it as an attachment. You're going to send in an email with the spreadsheet as an attachment, not inserted, or only if you're only buying one note, okay. But if you're going to attach a spreadsheet, make sure it's an attachment. Don't insert it into the email. Okay. Now, for negative equity, the stair-step pricing, here's what we talk about. Okay. And on the left-hand side, you have fair market value. On the right-hand side, you can kind of see where it's, or this is a percentage of fair market. So if you start seeing on the right side down here where it's assets below $30,000, okay, where the asset's greater, you know, right, that aspect, it's basically 25%. Okay. If it's 30,000 and above, 30 to 40, 35% of fair market value. If it's 40 to 49, 45. 50 to 59, 55%. If it's 60 plus, you probably need to be at 65% of fair market value on average. Okay. So keep that in mind. If it's a longer foreclosure process, then you maybe drop it down to 60. If it's a short foreclosure process, you may need to bump it up to 70. Obviously, look at the taxes owed and go from there. Okay. Now, I like targeting occupied assets because I have more exit strategies. Also, those properties are also usually in better shape. Okay. Which better shape means less expenses to if you do foreclose and to fix it up. Best thing though is if somebody's taking care of it, that tells you they want to stay in the property. They're easier to reinstate and modify, which is the number one strategy for us. Also, if there's somebody there that's easier to talk about a deed in lieu or cash for keys if they'll play ball. Borrowers will have emotional equity. If they're already behind and they're getting notices from your foreclosing, stuff like that, they've already started looking at what it would cost to rent or to move. And that can be something that we utilize as a marketing tactic. Say, listen, so you spending $2,000 to move and paying new deposits and uprooting your kids. Let's just put that $2,000 to the back payments and get you start making payments again. Okay. The most important thing about it too is, like I said, it's in better shape, so there's less capital expenditures. Usually somebody's taking care of the roof, the HVAC, the wiring, the plumbing. If it's a vacant asset and it's been vacant for a while, you're probably going to have to replace 1 to 2 of those things because especially if it's vandalized, you're going to have to replace a lot. So that's why we like occupied assets, owner occupied, because you've got somebody there who's got some emotional equity, taking care of the property, keeping the heat on, keeping the power on. And so the AC doesn't get ripped off and stolen. Okay. Questions? Does that make sense, everybody? Any questions about this before we move on to the next stuff? I know we're going through this stuff relatively fast, but I'm trying to give you guys the Cliff Notes version of this stuff. That's it. I know you guys have a lot of questions, and then what this class is designed for is help answer a lot of those questions when it comes to finding, funding, and then also the exit strategies. Okay. All right, let's talk about funding options. How do you buy a note? How do you fund a note? How do you pay for a note? Well, it's going to be cash. Well, no, you're not going to show up with a bag of cash, but a wire transfer. All right. You're going to wire money directly to the bank. You're not going through an escrow company. You're not going through a title company because the title's not changing. All right. You're wiring directly to the bank, and the bank is then sending an assignment of mortgage to you to go record. There's no title being changed on a note. Okay. You can use your own savings. You can own personal and business lines of credit for it if you want to use that, cash those out. Check with getfundable.com. That's Merrill Chandler. He's a great guy when it comes to helping people get lines of credit. He helps our students with lines of credit, personal business. He's helped us with lines of credit and getting better rates on things. So saved us hundreds of thousands of dollars. And he's also got a 2-day boot camp that he teaches called getfundablebootcamp.com. Okay. Uh, a lot of you are going to use OPM if you don't have your own money. Everybody should be using OPM. Okay. And by OPM, we mean like self-directed IRAs. Okay. People can use their Roth or traditional, the solo 401k. Okay. SEP IRAs, HSAs, you can self-direct. Okay. Educational IRAs, you can pull together a couple of your kids or have them not pool money, but having 3 or 4 people combine together to buy one note with the ESAs. Okay. You can open an SEIRA with an American IRA, who's who we recommend, American IRA out of North Carolina. Okay. And you can see that the amounts have changed in the last 2 years. The traditional Roth is at $7,000 for an individual. Solo 401k is at 23,005 or 70,000 total. HSAs is roughly individuals at 4,300, or as a family, it's 8,500, 8,550. Solo 401k is at 23,500. That's up a little bit. SEP IRAs have increased to 70,000. Great way. If you're not using an IRA of some sort, put money away into it. It's a great way to have savings or money there you can invest self-directed that pays off either tax deferred or tax free, depending on if it's a Roth or traditional. Okay. Other ways to fund and collateralize your stuff. If you've got an existing portfolio of performing notes, you can do a collateral assignment where a lender or private investor will take and hold those collateral for that and give you money to go buy notes. That's something that happens. A lot of hard money lenders use collateral assignments for that. Okay. A UCC one is filed against that entity, and like I said, the funder literally holds on to the collateral files for that aspect. Okay. We do a lot of co-assignments when you're starting off. This is where on the assignment of mortgage, if ABC Bank is selling you the note, it goes ABC Bank assigns to, instead of it just being your LLC, it could be your LLC and the LLC or IRA of the investor you're borrowing money from. We just say 50% interest to Scott Carson LLC and 50% interest to Greg Stolzman IRA. Pretty simple setup for that. If you've got a property with a ton of equity, you do a loan against the equity of that other property. If you've got existing notes, you can sell partials off if you want. That's the most over exaggerated thing in the note industry. You can start a new LLC with an investor and have them fund that LLC or buy shares in your LLC to fund it. Okay. And so there's a couple different ways to do it, to either A, keep the investor off of county records, or to securitize their thing. If you're using an IRA, pretty easy to set that up, whether they're investing in the fund or they're lending you money. You just got to set up a funding agreement. And it's just going to be a flat funding agreement, no equity deal. Just you're borrowing money from them for 24 to 36 months at 7 to 12% interest. Okay. Now, will a bank give me a note loan? No, banks will not lend on notes usually. Now, smaller banks may do collateral assignments on existing notes that you might have. Hard money lenders will do this, and they'll usually get about 50% of whatever they lent on as a collateral assignment. So something to keep in mind. Now, some banks on commercial stuff will reassign or joint venture on the deal. Usually it's $1 million plus, and you've got to have a team and or experience in a lot of cases for them to be willing to basically finance that note purchase to you. Most of the time it's going to happen where the operator has walked or the operator wants to hand over control. The bank doesn't want to operate the property. So they rather, instead of losing $1 million loan, keep the relationship and finance that commercial note to somebody to take it over, and goes from the non-performing side of the bank to the performing side. So it offsets it and allows it freed up some things. Now, they may require some percentage of down payment, 10%, 20% down is what we've seen. Sometimes they'll do 0%, depends on how motivated they are to get the asset off their books. Okay. Now, the hard money lenders will not lend on notes. Okay. They want quick turns. They like short-term loans, 6 to 12 months. They're going to make their points. They like control of the asset, the deed of trust, to be in that first lien position. They make their money on their points and the churn, and how often they can recycle that money, and then the spread. Okay. Now, they may have notes for sale on properties they've had to foreclose on, properties where the borrowers haven't paid, stuff like that. But you always want to make sure, if it's a note from a hard money lender, that's completely 100%. Some hard money loans are great short-term investments for note investors. Higher interest rates. If you've got some cheap funds out there, hey, somebody's going to give you money at 6%. Go put it in a hard money fund for 12% and make some money. Like I said, they can rinse and repeat it. And like I said, they may have some non-performing notes that you buy and take over if you don't mind taking the property back. Okay. What else do I add to the funding amount or deduct from the bid so that I'm fully finance that note purchase besides just the purchase price? So I will look at taxes owed and decide, will I have to pay property taxes? If there's 3 years behind, you're going to pay some property tax. If it's just the last year behind, I don't really worry about rolling that in, because if we can get the bar back on track for that, great. If not, then we'll go the foreclosure route. I'm going to look at values from BPOs or qualified realtors, CMA, comparative market analysis. And then if I'm going to bid something that I'm going to get below 70% of the loan balance and the note balance, then I'm going to look at what can I add. And like I said, I always put eyes on the asset. Send somebody out to take photos of the property, make sure it's the right asset in pretty good condition, because that will help you. Exterior condition is not always a mirror of what's going on inside, but it's a good judge of character. So I'm going to first budget in foreclosure costs. That could be $2,000 to $5,000, depending on the state. Taxes, workout and servicing costs. I'll throw in usually $1,500 for servicing costs. Depending on the state, I'll probably bump that up. If it's a longer judicial state, I'm going to bump that up more. I'm going to throw in, try to figure in, depending on what kind of condition events, probably some cleanup costs, paint, carpet. I got to figure that out. Make sure there's room for that above what I'm paying for the note. Clean out's like $1,500 usually. It's not too difficult. It's the carpet and paint. It'll vary a little bit. You're going to want to put forced place insurance if you're going to have to foreclose on that. That will vary state by state. That's insurance in case something happens. And you don't have interior inspections on these things, remember, most of the time. So you put forced place insurance in case, A, the borrower gets disgruntled, an act of God like a tornado or a flood, or you don't see inside, you foreclose, open the doors, and there's mold everywhere. Forced place insurance, you can prove that you didn't have interior views. So it's insurance in case you've got to file a claim for that. I'll look at utilities, HOAs, code enforcement liens that don't go away. Code enforcement liens are not too worried about, because usually most municipalities, when you reach out to them and say, hey, I'm buying this note, we're going to foreclose and take the asset back, any liens on this can be removed. And oftentimes they'll remove the liens as long as you're fixing the property up. They'll remove a lot of stuff, okay? So keep that in mind. All right. And then if you got room, put in $500 to $1,000 in marketing costs, asset management fees, because it costs money for marketing. It costs money for you to do some of this due diligence that you're not always going to get paid on. Sometimes paying for a broker price opinion, you're going to pay for 10, you may only end up with 4. So that's 6 BPOs. It might cost you $600 that you want to get compensated for and get paid back. So just keep that in mind. All right. And I just disclosed this. Hey, this is why you were buying the note at 45, but I'm going to have you fund 55. And this is the reason why we're going to have you hit. This is what these are all figured in. Okay. You want to try to stay below 65% of the balance or the value, depending on whichever is lower, as is fair market value when funding. So that they owe more than the property's worth. You don't really want to be above 65% of as is fair market value. Okay. Now, if you foreclose and take the property back, you can then turn around and put your investors partnership or whatever, not partnership, but funding amount and slap a first lien on the property so they're in a secured position. When you take the property back as an REO, go get a hard money lender to refinance them out if they want to get out of the deal. Now you've got repairs and stuff covered that way. Need to. Okay. 5 things that are going to be protecting your investor, and this is very important to keep in mind. 1, that you're only buying first liens. Okay. Buy first liens only. It's less headaches. You're guaranteed of some sort of exit strategy in 24 to 36 months versus second liens, which you can drag out years. Okay. You're buying only below 70% of as is value. That way, if there's something goes wrong, you usually can sell it and the investor's going to get their money back in full and move on. Okay. Use a servicing company for your collection, attorneys to collect and foreclose on. You're not doing it all. Okay. You're not rehabbing the property by rehabbing the borrower. Okay. Use professionals who are licensed to do this so you don't have to prove concept. Okay. All right. Proof of concept is look at the millions of people that have a mortgage. It's paying on time. That's what you're tapping into. You're doing it just on a smaller basis because you've got insight into it. Okay. Forced place insurance. We talked about that in case of an act of God or disgruntled borrower. And 5, you're always going to check title and the collateral files to make sure you have the right to foreclose, make sure everything is in it. This is what you're buying. This collateral file. This is actually what you're buying, not the actual property. Now, this secures the property as collateral for the loan. This is stronger than your hammer. The pen is mightier than the hammer all day long and twice on Sunday. Okay. But that's what you're buying is that collateral file. All right. But those are 5 things that we're always going to talk about doing. Buying only first liens, buying at 70% of value or less, using servicing companies and attorneys to foreclose, forced place insurance in case of an act of God, and checking title and collateral files, make sure we have the right and everything is hunky-dory, all the T's are crossed and the I's are dotted to foreclose. If we don't have those, guess what? We're not going to do the deal. All right. Question before we move on to session 7, finding investors, which is one of your guys' favorite things to talk about. And it's one of my favorite things to talk about because it's easier than ever to find real estate investors to fund your deal. And yes, I am still paying attention to the YouTube live stream. I see we got a few folks on there. Good morning, everybody. Feel free to chat in and ask questions on there as well, besides here in the Zoom stream. All right. Let's get rocking and rolling along here, everybody. All right. Find investors to fund your deals. I mean, yes, people would love it. I want to use my own money to start off with. That's great. But don't make the mistake of limiting yourself to what's in your IRA account or what's in your checking account. Everybody uses other people's money to fund these deals, and you need to do the same thing as well. Okay. Otherwise, you're going to be sitting here waiting for one note to pay off before you go do more. And that's a slow boat to China. Okay. There's millions and millions and millions of money sitting on the sidelines out there waiting to be put to work. So, first place to go, I was just talking to an investor the other day about this. Start going and attending local real estate investment clubs and meetup groups. Start networking, start talking with people. You're not going to some people will find investors right off the bat, but you need to go on a regular basis, start networking and going from there. LinkedIn is a great way to start connecting with people, sharing content in there, or reaching out to people to start the conversation. Don't connect with somebody and just pitch them to death right off the bat. Okay. But you can use keywords, LinkedIn groups, different profiles on there to find investors to fund your deals. Connected Investor has some opportunities. Bigger Pockets is some different ways. I'm not a big fan of either, but there are some ways to use Bigger Pockets to find people that are literally saying they've got $100 grand to invest. Okay. And then one thing that you can do is put together a pitch deck video, which we go through in our 3-day workshop. Not difficult to put together, just a presentation about what you're doing. You're upping your game. You might as well up your presentations a little bit, okay? I like going and attending self-directed IRA custodian events. Some companies will host these once a year. Some will host monthly events for networking in their local markets. So check them out at an IRA event near you, okay? I like finding investors on public records. This is with people that I know that have pulled the trigger, they have money, and it tells me they have money. So you can use netraonline.com. This is a website we use for due diligence all the time. It connects all the county records websites together. It's free to go to. Okay. Um, we go to Netra Online and then we start going to different county appraisal districts. Now, this works in states that are just states. Now, if you're in a state that doesn't disclose, like California, Arizona, Virginia, Maryland, Minnesota, New York, this is not going to work to find investors because they want you to type in the address. Well, you don't know the address. And I'll talk about why we do this in a second. Okay. But you can also look at the county clerk's recorder's office. This will work in every state if you got access to it. Now, you may have to pay a small fee in some areas to join the county records. It's worth it. Okay. But we are targeting people who have used their self-directed IRA to lend or buy property. Okay, it's a little bit different, whether it's the appraisal district or the recording office or the clerk office. Okay. And we'll walk you through it. So what we do is when we are able to search by name, we do a search for self-directed IRA custodians like Quest, Equity Trust, Pensco in the areas of that county. So if you go to the county appraisal district, there's over 50 plus self-directed IRA company names out there right now. We'll jump on and it says property owner. We'll type in Equity Trust and it'll pull up everybody who has bought a piece of property with their Equity Trust account. In seconds, you can find hundreds of people who've used their IRA to buy a rental property or a property they can't touch. It's got to be passive. Okay. And it's got their mailing address. A lot of times, well, not a lot of times, but a chunk of the time, it's going to be the mailing address of the IRA company. So go ahead and send a postcard, send a letter to them. All right. They're supposed to scan it and send them an email with that information. Okay. Mailing addresses are right there, usually in the assignments. Some of the websites out there will allow you to download the mailing address along with the actual physical address so you can do an easy mail merge. We'll send out a letter or a postcard. Okay. Or we'll send a list to our VA and they'll go out and find them on LinkedIn or Facebook and put their URL and we can market to them directly. We can also see if they own other real estate in that area by their name. But just doing a quick search by their name in the same county, right? But this is a way for you to find literally hundreds of people in just a few minutes. And then you can take their name and if you want to take the address and do a reverse search on White Pages or Google or Spokio to find and skip trace them in as well. But this works just about everywhere. And we send a postcard at first. Hey, we saw that you use your IRA to buy a piece of property. Still looking for more deals. We'd love to talk with you. We never pitch them right off the bat. Hey, want to fund our deal? Okay. We're just saying, hey, we'd like to connect with other investors. And same thing on the clerk. The clerk is different. The clerk recorder's office, you'll do a deed search and you'll see people who have lent money out of their IRA to people. So you get the account holder's name, who's the lender. You'll also get the investor side of it too. Same thing, got a mailing address, the amount they've lent, oftentimes to the investor borrower. And the same thing, we send a letter, postcard, hey, saw that you lent money out of it. You could also do a release of lien besides a deed search. And that will also show people who have lent money, but then got their money back. And that's a hot button because most real estate investors are lending money and want to be lending money on a regular basis. Okay. And this is a system that you can rinse and repeat. You don't need hundreds and hundreds and hundreds of thousands of people, but if you got 200, 300 IRA investors with just normal direct mail at 4% open rates, response rates, that's pretty good. So 200 times 4% is 8 people with an average of 150 or more. That's over $1 million in private capital for you. You just got to put it to work and go for them. You can also purchase custom lists from like IRA owners, not specific to self-directed IRA custodians. So you can buy a list from like Melissa Data, Exact Data. You can buy them like, hey, we want somebody that's got more than 150K or more. Pick it by city, state, or county across the country. You can also buy lists of employees from a company. Like if I wanted to buy everybody's name from Halliburton who works for Halliburton, that's a pretty good list because they got pretty good IRAs. I can buy a list with their contact information, name, address, email, phone number. Melissa Data or exactdata.com are two sources we use for that. Now, usually they're going to want a minimum order of about $1,000 to start off with, but $1,000 divided by like 6 to 14 cents, that's like 16,000 names in an area. All right, like I've bought the full list of IRA holders in Houston or Harris County, same thing in San Diego County, and the generic list of IRA owners is a little bit more difficult because not all of them are investing in real estate, but it's still a very valuable list. And then we do some other marketing to those lists to help drive engagement or get people to click on things or to contact us. Now, where can you post? Post deals. Another thing you should be doing is past deals and current deals. Posting those. If you have no current deals, pass from your past experience. Here's a deal that we did this. Here's a deal that somebody else is doing or done. Okay. Post deals you're working on. Here's a non-performing note that we're working on. Never mention safe or guaranteed in your marketing. That's illegal to do. I like creating a short pitch deck video that's 10 minutes or less, talking about kind of what you do and the types of deals you're doing. This is a very effective thing. And in your video, on your pitch deck, is to be about you, your focus, your company and team, your vendors, and the types of deals that you're doing, and then the ask. Okay. When you get people to respond to you, you're going to want to start qualifying these investors because not everybody is going to be a fit for your deals. Okay. First thing, are they currently investing in real estate? Yes or no? If they are, yes, great. How's that working for them? If no, then you're going to do a little bit more education on it. Okay. Are they accredited or sophisticated? If you're borrowing money, 50K from somebody for 24 to 36 months, and they're a real estate investor, that's not a problem to do. You don't want to get into pooling funds. When you start pooling funds, then you want to start sticking to accredited investors and putting some money into a PPM. Okay. How much are they looking to invest? You've got to ask this question. How much are you looking to invest? Because if you don't ask that question, you may be wasting your time with somebody who's got 5,000 to invest. You need somebody who's going to put 50 grand or more to start off with. 5 grand, 10 grand, that number is great, but it's not worth you guys spending time on. And how long are they looking to invest? Note investing takes longer than, say, a quick fix and flip. So if the money's sitting in an IRA account that's not been touched in 24 months, guess what? It's not going to hurt them to put it into a 24-month investment deal. Heck, if it was sitting in a CD, it'd be a 12-month at least. If it was in an annuity, it's 7 years. So keep that in mind. Are they active or passive? Either way, it's fine, but an active investor may want to get a 15% or higher. Don't do that. Find out where that money's coming from. Has it been active or passive? Now, if they want 15%, they're probably not a fit for your deals. Okay. That's why it comes down to what kind of returns they're looking for. Ask that question. If they say, I want half, well, then you're not a fit. There's plenty of fish in the sea, ladies and gentlemen. We use an investment questionnaire in our classes that is in a 3-day for you guys to use as a great guide point to walking people through asking questions to see if they qualify or a fit. Okay. Now, there are investors that you want to avoid, people that are unfamiliar with notes or real estate. They're not always the greatest aspect of things. People wanting short-term or higher ROIs, like I only want my money to be out in 90 days. Well, we're not a fit for that. I want to make 20% or more. Well, we're not a fit. Investments below 50,000, we talked about the reason why for that. Look at people's social. People will cancel themselves out faster than me saying Jiminy Christmas or Jiminy Cricket because they post bad politics, bad about everything, negative Nancy. Just stop. Don't deal with those type of people. People are too happy. One of the things we ask an investment questionnaire, have you ever been involved in a lawsuit? Are you involved currently in a lawsuit or bankruptcy? Just want to know about it. Okay. And you're asking for references just as much as they're interviewing you. Have you done business with anybody before? How did that go? Good, bad, ugly? Why did the deal go bad? Because you get some people, if you promise 12%, you come in at 11.99, they're going to get mad. Okay. So I don't mind sending them over the agreement to take a look at, but I'm like, listen, if you're going to be asking your attorney, has they invested in real estate before? Do they know the ins and outs of this? No, then why are you asking them? Your banker's not going to prove anything because they're a banker. They can't. CPA can't give you advice. All right. Always require investors to do a couple of things before to help them get you to the funding table. Okay. They're always going to need to require them to fill out the investment questionnaire or investor profile questionnaire form and return that to you. If they don't send that in, they won't fund. Send you a pledge letter or email saying, hey, Scott, it was great talking with you. I'm pledging 50K or I'm pledging 100K out of my attached statement, which is the next thing, another thing you want, proof of funds, to note deals for 24 to 36 months. You require this in case they flake that you can go to the seller and say, hey, my investor flaked on me, but I proofed up, you can see all their information. Let me move on to my backup source, okay? If they won't return these 3 items, they're not going to fund, period. End of statement. There's nothing I'm holding them to the deal. If they even fill out the funding letter and they flake on that, we've had people do that before, okay? If they're going to be using money from like a Schwab account or an AG Edwards, you've got to move that money over to how they're going to fund it. They want to use it in an IRA account, they need to move it over to a true self-directed IRA account with a trustee, okay? So find a good self-directed IRA custodian trustee that you can actually have a relationship with that you can refer new clients to. Now, it's going to take 3 days for them to move that money out of funds, stocks, bonds into cash, and then wire that over. So it's going to take, you're looking literally at a week minimum, if not longer. So stay on top of these people, stay on top of investors, make sure they're setting things up and getting the ball rock and roll. This is very important. Have work created by an attorney, funding agreement. We have them sign some disclosures, outlining everything in the deal. Okay. We allow CPA returns reviewed. Doesn't mean we're going to change it up. We might tweak it a little bit, but we're not going to change it up. Attorneys have a good way of screwing shit up, as we all know that. Always use agreements, even if it was your uncle, your mom, or dad. It outlines when things go wrong. Okay. And you got to realize this too, ladies and gentlemen. Most investors can't make 6% or greater in the market right now. Okay. If they are, good for them. If they aren't, because they've probably got money sitting on the sidelines, then guess what? 6% is a pretty good deal for them not to do anything. Okay. It's an above average return if they're making zero. Now, when it comes to payments and communication on the deals, obviously, if making payments to them, make it quarterly, not monthly. Okay. I have it set up in our agreements for buying non-performing notes that we don't start making monthly payments or quarterly payments until the borrower starts paying on time. If the borrower doesn't pay on time or isn't paying at all, then we only make it to the end lump sum when we foreclose, we pay them monthly. Or if we take the property back and rent it, then we'll make payments to them when we have cash flow coming in. If we have no cash flow coming in, we're not making payments. We set up an online portal. We use Basecamp. It's pretty simple for people. We'll share the assets that, the collateral files. We'll email back and forth there. It's a great way to do that. But you can use a variety of tools, Slack, any type of CRM, Dropbox, Google Sheets, Podio, Pipedrive. There's a whole variety of different CRMs to use. The most important thing is never pool investors' money together. One investor per asset. Okay. If you don't have enough investors, if you don't have enough money or an investor with enough money, then don't do 2 people in there and you're borrowing money from 2 people for one deal. Make them, if they know each other, go start an LLC and then borrow from that LLC. Okay. Trust your instincts. There are bad people out there that are just assholes and assets. Too happy. Biggest mistake I ever made was I didn't make my agreements initially long enough. You should always make your agreements 2 years, 24 months, especially non-performing notes. And if I'd done that, it saved a lot of headache. And 2 is there's a few people I let invest with me that I shouldn't have. They're just, I was trying to get a deal closed and I violated my own rule. So keep that in mind. It's better to just say no to the deal and ask for more time to find a better funding source. All right. Questions before we dive into the note marketing side of the business, ladies and gentlemen? Actually, this would be a good time. Let's take another quick let's just do an 8-minute break here. We'll come back at 2 minutes past the hour. All right, let's dive in, ladies and gentlemen. We got a lot of stuff to cover here still today. So let's dive into marketing your note business, or note marketing, as I like to call it. Now, one of my favorite things besides the raising capital side and finding investors, which I don't know why I'm one of the few people that teach that, is this aspect of marketing. Now, once again, I've said this before, 80% of sales is made after the 5th contact. This is why you need to market your business, because not everybody is just waiting around for an email or one post in a Facebook group. You got to hit them with repeated other content. And you have to expect to post regularly and often. Now, that's the thing. You don't have to go there and post every time yourselves. There's some ways to automate this to make it simple for you through a posting service like Buffer or using Opus Clip AI or some things like that. Not difficult to use. Hootsuite's another one you can use, a little bit more expensive, but you can automate some of your marketing posts. And there are 3 things that you really need to be posting to in this world today. Okay. It's 2025. You got to embrace using an email CRM, keep.com or REI Blackbook, LinkedIn, and you can automate with Octopus CRM or Buffer. And video marketing, short videos, longer videos. There's so many easy ways to create video, or you out there taking selfies of properties or talk about deals. It helps tremendously. Okay. Email marketing, send an email out regularly. We talked about sending out emails to your asset manager list. You want to send an email out regularly to your warm database. All right. Sending out on a Tuesday, Thursday, or sending out to email contacts or your warm database on a Sunday night at 7 p.m. works really well. Okay. Now, what do I talk about in those weekly emails? It may be every month is a holiday, so happy holiday. Okay. I may do an upcoming meetup or networking event that I'm going to, or conference I'm going to, or speaking at, or something else that's networking. You can talk about your local RIA club. It's a great way. Hey, join me here locally. A personal event, something fun, family. I do it usually after the fact, so people don't break into houses. Hey, we just took our family to Disney World, or hey, we just went to the county fair. Or, hey, we just saw Texas stomp on Oklahoma again. Things like that. There's something fun. And then talk about past or present deals. People love case studies. Hey, here's a property that we flipped before photos or after photos, or here's a story about this property. Okay. The reason you want to do this on a weekly basis is and talk about past deals is that when you have a deal that you're looking for funding, you want to already have that trust in place. The biggest mistake people make is they market for money when they need money, and that's already late. Okay. But sending one email out to your database on a Sunday night of things that are going on or upcoming or inviting people to something, it's a great way to build rapport and build trust. Okay. It just doesn't have to be all real estate, real estate, real estate. Okay. Share something fun. All right. And like I said, you're going to send an email out to your different asset managers 1 to twice a month as well. So use something and start sending it. It's just an effective way to build rapport both ways. Okay. LinkedIn, you got to leverage this. Complete your profile 100%. Put a good photo of yourself on there. It literally is a social media business resume. It's actually where bankers and lenders are going there to look at you. Investors are going to go there to find out if you're connected to you. We use Octopus CRM to help maximize your connections on a daily basis. It's a Google plugin that links in with LinkedIn that I can pull a list of people and send automate connection requests through LinkedIn. It's not going in through your email, but still a good way to target people on LinkedIn and make it automatic where you don't have to sit there and hit the connection request button every time. Okay. Only 3% of LinkedIn users post daily. Guess what? You can post pictures, properties, articles, news articles, all really good stuff. Join and post to the different groups that are available out there in LinkedIn. There's some big groups out there as well. And you can import your lists into LinkedIn. Smaller lists is a little more difficult than it used to be, but you still can upload lists, emails, and they'll go out and find those people on LinkedIn if you've got a smaller list. Okay. And this is the thing that's everybody's just like, video marketing. Now, video marketing, YouTube is the second largest search engine owned by the largest search engine. Okay. So you're stupid not to post it on there, to have it go viral, to have people at least see what the hell you're doing. And here's the thing. I've been leveraging video, golly, for a long, long time, a lot more than others have, right? This is why we have the number one YouTube channel, why we have the number one podcast. Okay. But I don't care. All I need for a video to be work is for at least one new person to see it. One person to see my video could be the right person. I've had videos that had like 5, 10 views that somebody saw it and they called me. It works. How many of you have watched some of my videos before to find out what's going on? Many of you have. Okay. Many of you have. We use TubeBuddy. It's a plugin to help us grow. It helps us do some competitive analysts on our competitors to find out. Short videos do well under 3 minutes. So 3 minutes could be you talking about a deal or something. Just get in a consistent habit of doing it. It's something 24 hours a day, 7 days a week, 365 days a year. Advertising for you. And if you upload a video, use a good description, keywords, and thumbnails to help you out. It's just going to help you. If you're using short videos, they don't really need the thumbnails, but good description, a few keywords are going to help you grow your channel pretty fast. Facebook Live, if you use Facebook Live, it's only got about 24 to 40-hour lifespan. So if you're going to use something on there, use your deal case studies to share on there, but it's still not going to be there. Actually, after 30 days, those videos start getting deleted too. So YouTube's better, but you can reshare the same videos you throw on YouTube up to Facebook. LinkedIn Live, really working well. We like LinkedIn Live. We use a service called Restream to share everywhere: YouTube, Facebook, LinkedIn, Twitter, Instagram. But smartphone selfies on videos or walkthroughs, this is really popular, and every platform is leveraging video. TikTok as well. Go ahead and start using it. Okay. We believe in something called the marketing octagon for content, where you can take one piece of content and share it across multiple platforms, multiple channels. Photos and stories do best. Like I said, buffer to share across multiple platforms. Not everyone is on every platform. That's why you want to pollinate and cross. Instead of throwing one line out in the water, you want to cast a net to catch with everybody. Okay. And the more you cross promote, the more hits that you're going to get. And the best times to post, if you want to set it up on automatic postings, is 3 p.m. Lunch, 3 p.m., 7 p.m., and 9 p.m. Also, if you can get one like at 9 o'clock in the morning on Saturday, Sunday, it works well there as well, too. Start with one new thing each week. All right. We've gotten to the point where we're posting one short video under 3 minutes, usually between 5 and 10 times per day, from like 10 a.m. to 7 o'clock at night. And it's automatic stuff through one thing. And it's helped us grow our channel, YouTube channel views, from basically, it would be like 5,000, maybe 10,000 views a month, up to 80, 90,000 views a month. So it's a big difference. Okay. Helped us with connections and all sorts of great stuff. Okay. Business structures. Let's dive into how do you structure your note business. Unless there's some questions about marketing, we can go back to. Structuring your business is pretty easy. All right. You're going to do it mostly with entities, LLCs or trusts or S corps. Preferably LLCs are going to be the easiest thing for you to set up. Well, I have an LLC with my existing business. Can I use that? Well, yes, you could use that initially, but I would not. I would keep your businesses separate. Now, you don't need a new LLC for every note that you buy. I don't usually keep more than $1 million in assets in one LLC. The S corp is kind of the management company, all right, overall. Now, if you're using other people's money, it's good to split those up as well. If somebody's bringing $250,000 with it, you may want to have set up an LLC just for their investments. Okay. Let's see here. Yep, said that. You keep your deals assets separate from partners, existing business. If you've got some performing notes on the side, keep those in one spot. If you got rental properties, keep that in a separate LLC. If you got a commercial building, they should all get their own LLC. If you're doing education and marketing, keep that in a separate LLC. And then there's a management company for doing other things. Just look, I get it. That seems like a lot. When you're starting off brand new, just get you one LLC and work with that. And then as you grow, add LLCs. It will help you in the long run with asset protection. Okay. Well, can I just use my self-directed IRA? Yeah, you can do that for sure. But it's not smart to fund in your own name or IRA. People like me can go track you down, right? So it's a good way to use, but you can also use an IRA LLC. But not funding your own name is going to be asset protection. While the Consumer Finance Protection Bureau has kind of had its legs chopped out, it's gone with Trump, there are still other entities out there tracking in case people file complaints of you. The last thing you want to do is buy a non-performing note with your IRA, have to evict somebody, and get a disgruntled borrower filing complaints against you. Okay. Some counties are actually suing the trustees for back taxes, like Wayne County in Michigan was suing Equity Trust, Request Trust, for lack of property tax. Even though it was individual IRA owners, they were still suing the major companies. So keep that in mind. Funding our joint venture partners, you definitely want to keep it separate. Self-directed IRA LLCs or checkbook access are not bad. But if you're using your own IRA, it's pretty easy just to use a traditional to get things rock and run. Checkbook IRAs are great for speed things, but most of your stuff is going to have, unless you're using like a tax liens or going to the foreclosure auction, you don't need anything that fast for the most part. Okay. Trusts are really not recommended. Now, you can use trusts when you're buying stuff and holding it, but if you're going to foreclose of some sort, then you're probably going to end up having to put it in an LLC. Okay. You need to document your business. Having an LLC is just not a trip to the Secretary of State and getting a tax ID number. You need to document your transactions. This all comes from our buddies at Laughlin Associates that teach us this is exactly right. Even if you're a single member LLC, you still need to document your contracts, JV funding partners, offices, vendors, leases, and a variety of other decisions. And we recommend Laughlin Associates. They're out of Reno, Nevada. They've been doing it 50 plus years of keeping and creating LLCs for investors. They help with asset protection and structuring. They have a great corporate veil protection plan to help you with the documentation in case you ever do get sued, or if you ever have the IRS want to audit your books, you audit your IRA. They're not going to audit your books, but they're going to help you with your documentation. And They've got some great different things that you can set up for asset protection depending on where you're at. They also host a biannual event called Magnify Your Wealth Summit at magnifyyourwealth.com. And that's a great place to go to network with other investors and get the ball rocking on. And you can sign up at lawfulusa.com. Check them out. Check out magnifyyourwealth.com to find out what the next event is. And that's a great way to go. Actually, let me just pull it up here while I'm thinking about it. Let me just share my screen. I should have the internet up. Yeah, let's go here over to that. Go to magnifyyourwealth.com. They just had one out in San Diego, and the next one is, oh, they haven't updated the date yet. You see April 25th, they had it exactly 2 months ago, or under 2 months ago. Oh, there's a picture of me there. But they should have one upcoming probably in Orlando or San Diego. So what they like to do, okay? But well worth it. Go register for it. It's usually pretty cheap. Our one-on-one coaching students get a free access pass to it. So let me go back here. All right. Any questions about that before we dive into exit strategies? This is how we make the money once we've bought the note, is exit strategies. What do you do with a note once you bought it, right? All right. There's 10 ways basically to skin a note, as we like to say. We've got a longer video that does a deeper dive into the different exit strategies at this link. The first thing you can do, you can wholesale notes just like you wholesale property. You can flip contracts. You can do it for a flat fee or a percentage, okay? Depending on the funding amount or depending on the asset class. Like if you're flipping a portfolio of performing notes or wholesaling, it's usually 1 point. If it's non-performing notes, like 3 points. Just varies a little bit on that amount, okay? If you're flipping stuff to people you don't deal with or brand new, I would do a double contract, double closing. And that way you're not disclosing who the seller is. They'll eventually find out who the seller is, but you're protecting yourself and your position. You can do a signed fee agreement too if you understand the borrower or the buyer, sorry. We've just done a flat wholesale agreement with students who send us stuff. We're going to buy, give them $5,000. We'll just do a flat 5K or whatever it might be, okay? If you're going to use a double contract for sure, somebody brand new, use a real estate attorney's escrow account. That may cost you $500 to $750 to set up, just for them to basically receive the money and then wire the money out, okay? If you're going to wholesale, good wholesalers know their deal and market it. So you really need to know your deal and learn how to market it, okay? And if you're going to wholesale and you're going to market, you might as well just start marketing for raising capital instead of just buyers so you can buy more deals. But, okay, wholesale and everybody can do that. The next thing is when you buy a non-performing note and try to get the borrower to start paying, because your servicing company is going to start reaching out to them. It starts re-performing and paying on time. They're going to ask, can you reinstate the loan? The licensed servicer is going to reach out, say, hey, can you start paying on time? They're starting to collect some payments. Something called right party contact, RPC, is what the servicer refers to that for borrower outreach. Servicing companies will start reaching out to them on a weekly basis. Hey, can you start paying? That's the whole goal. You instruct the servicer to do what you want them to do. Accept monthly payments plus some. Get some lump sum up in the front side, whatever it might be. You do a loan forbearance agreement where you put the back end of the loan. That happened a lot during COVID. There's a whole variety of ways to get the borrower back, start paying on time again, but that's the next thing that you want to do. Third thing is they modify the loan or do some sort of trial payment plan, okay? Trial payment plan is what you want to do usually the first 12 months, and then a loan modification, permanent modification. The reason you do 12 months like that, because if you modify the loan immediately and forgive debt, you can't go back and collect on that forgiven debt if they stop paying, okay? So the idea is to get them start making payments with some sort of a lump sum per month. We do a trial payment plan 12 months. Sometimes you do 6 months if they bring a lot to the table, okay? But you can do whatever you want in modifying that loan. Adjust the payment balance, forgive, reduce back payments, adjust payments, whatever it might be. Never go straight to a loan modification before 12 months because that becomes a short-term capital gain. It also restarts the time frames we just mentioned, okay? Borrower will need to sign the trial payment plan and loan modification. Your servicer can help create this. If you have an attorney, I would just have your servicer do it. Attorney will do it, but it'll cost you more to set that up. Usually what happens is when we buy a portfolio non-performing, we've done enough due diligence to know, hey, we want either A, if they're going to start paying, we want this amount up front. If they can get more, great. But this is the least amount that we'll accept, and this is the least amount that we'll accept monthly. All right, if they won't work, then we need to go to like a deed in lieu, cash for keys, or the next step. You can offer a loan payoff. Okay, buyer pays off the loan. They can cash it their 401k. You can offer a reduced payoff amount. They do it in like 30 days. We've done a payoff amount over 90 days where they did lump sums for 90 days. They're not going if it's there on their owner occupant, you got to realize they're not going to get a bank loan. So you got to know where that money's coming from. If they say they're going to go to their bank and get a loan to refinance, that's not going to happen at all. Okay. Now, if they've got a business or a line of credit they can prove they have, okay, we'll work with them on that. If it's an investment property or they don't own the property, it's like an estate or heir, then they might be able to go to a hard money lender or an investor buyer and get that taken care of. Or like look at the 401k. What do you have in your retirement to cash out to pay off? You're going to handle the payoff, the settlement, and the release of the lien with the servicing company. They're going to send you the document, or you may need to create a release of lien to file once the loan is paid off. You can always allow the bar to do a loan assumption, let somebody else take over to assume the loan. All right. Family member, friend, potential investor, whatever it might be. I always have them still fill out a new loan qualification form. We're not creating a new loan, so I don't need an RMLO to do this. We're just having them fill out information so we know their information. They're not getting a new loan. It's existing loan as is. If they want a new loan, then they need to pay us off. Okay. We aren't refinancing, so that's not the case. They're keeping the exact same payment, unpaid balance, terms, all the stuff stays the same. Now the borrower can quit claim it to the new note payer. Or if the note payer stops paying, we're going to foreclose and go that route. Okay. You can do a short sale. Allow the borrower to do a short sale, sell the property at amount below payoff. The bank, has to approve the short sale. Usually, if somebody wants to do this, we tell them to list it on the MLS for 85% of the current fair market value. Not 100%, but at 85%, because buyers don't want to wait around for a short sale. Even though we don't take 6 months to do a short sale, you still want to put it on there where there's lender approved. That way, at 85%, they're getting multiple traffic, people to the house, hopefully. Now, if there's no bookings and nothing's happened, well, we make sure it wasn't because of the bar. We're not going to let the bar schedule around their schedule. It's got to be able to show at any given time. Okay. If we don't get any traffic in the first, usually 2 weeks to 30 days, then we'll look to do a deed in lieu or a consent to judgment. We're going to reduce the realtor commissions to 4%. If we've got to bleed, everybody's got to bleed. Okay. So that's the thing to keep in mind. It's a good thing to do if it's in a decent property, but if it's in a bad area, or it's not a bad area, but a slower area, then you probably want to move to a deed in lieu cash for keys. And then here's the thing. If the borrower, you can always 1099 them for what you forgive them, and they can write it off. You do that to write that off your side, but they can do a IRS form 928 to absolve them of that, but it still offsets your taxes, which is great. Okay. Deed in lieu or cash for keys or friendly foreclosure, we kind of call this. We let the borrower walk scot-free. The borrower deeds the property back to us, the bank. We forgive the debt at that point after it. Sometimes we'll do $500 or more to expedite taking the property back. Usually we're not going to give them more than what it would cost us to foreclose. Okay. If there's back taxes, everything owed, we've got to pay that. We'll reduce that from the amount, but we're going to get them some money to get out of the property. And we're not going to give them money without them signing. So like if they want $5,000, we'll give them $5,000. We'll give them $500 to sign and then $4,500 when they're moved out. Okay. Property's got to be clean swept, and it'll help them avoid a foreclosure on their credits. We're actually helping them out quite a bit. You always want to run title, make sure there's no liens on the property above yours. There may be some like not tax lien, but municipal lien or something like that. Take a look at it so you know what you're inheriting if you can't wipe it out. If there are a second mortgage or other things, then you're going to want to do a consent to judgment and then finish the foreclosure to wipe them out. And getting a consent to judgment, well, you can take that in front of the judge and show, hey, the borrower's agreed to the consent. We're just going to go ahead and foreclose and wipe out. Okay. But always pull photo and take internal photos to make sure you're getting into it right. All right. Sell the asset to an investor. If you bought that note and it's going to go down a route, it's a foreclosure, you're dealing with a property difficult borrower, you can always flip it to somebody else. Okay. You actually created knowledge knowing which way the exit will go. And this is before selling as a reperforming note. If you know you bought it cheap enough, you could turn around and sell that note to somebody else to handle it. Okay. Many funds will buy notes, work to modify in 90 days. If the borrowers aren't modified in 90 days, then they'll look to sell that note to other investors at 10% or more of the purchase price so they can make a quick buck. You also sell to local investors, market via local meetups, groups, realtors that, hey, I've got a non-performing note, I'm going to foreclose, like a pocket listing, to real estate savvy realtors or investor friendly realtors, like a handyman special. But you have to disclose, obviously, they're buying the note, they're going to foreclose before they can own it. Okay. The only problem with this is that you don't get interior inspection reports. You don't get to go inside the asset most of the time. So keep that in mind. All right. Of course, if you can't get them to do a deed in lieu, cash for keys, then you got to foreclose. Non-judicial foreclosure is faster, cheaper, starts at $1,000, like in Harris County, Texas. Longer judicial process starts at like $2,500 plus. You can either A, sell it at the foreclosure auction, which is what we try to do. If it doesn't sell at the auction because nobody bid on it, the big thing is that banks like will list it at full value or full legal to try to sell it that way. That's not always going to work. If they owe more than the property's worth and we don't own the property, we're going to list that asset for sale at 80 to 90% of as is value to get paid off and move on. If it's not sold, now you own the property. Now you take it back as an REO. The foreclosure cleans title, wipes out everything behind yours. Doesn't wipe out tax liens or taxes, so you got to pay that. I mean, federal tax liens is different, like IRS tax liens, but your property taxes, those don't get wiped out. You've got to pay those. Okay. If you take it back, make sure to place a lien on the property for the funding investor and asset protection. There are unscrupulous people that target foreclosure auctions and go slap fraudulent liens on properties after the fact, hoping that you'll pay those off to them instead of waiting the 90 days to get get a clear title action. Okay, so it kicks it off because they know it's a fraudulent lien. Okay, 10 is if you've bought a non-performing note and gotten some payments, some skin in the game, you can sell it as a reperforming note. You know, if you want, you're going to need to do this with 6 to 12 months of on-time payments to get the most amount of it. Some sellers say, oh, the borrower is expressed interest in a mod. Well, that doesn't mean they're going to do it. I haven't collected anything. You need a third-party servicer to really add value to this. Don't try to do this on yourself. Seriously, guys, pay the monthly payment to a servicing company. Okay. You know, now if the borrower's paying like $500 extra, you can only sell your um, loan amount based on the unpaid balance or the legal balance or the P&I, not the extra. Okay. Keep that in mind. Borrower may still be behind, but paid 6 to 12 months straight to get back on track. Okay. Bankruptcy loans are its own little ball game. Some people don't like bankruptcy because you come from the real estate side, like, oh, the borrower filed bankruptcy, they're trying to stay in the house, so I can't get the house. We like bankruptcy loans. Now, you need a BK attorney to collect. A servicer can help you with that. They usually will have a bankruptcy attorney on file that does stuff in that state. A BK Chapter 13 is going to be a debt restructuring. You can actually pull up the BK file to see what the BK report is, what the borrower's offered up as a payment plan. It becomes basically a 5-year payment stream for the most part. And you have the right to not approve the payment plan if it's bad. Like we have a student who's borrowed and paid in 10 years. Now they're trying to file bankruptcy to delay the foreclosure, and the payments just don't make sense. So he's saying, no, this is not in good faith. Not in good faith. But there are some Wall Street firms that target BK Chapter 13 funds, and they'll pay 80 to 90% of the unpaid balance to buy that note from you. And if they stop making payments, you can discharge the mortgage from the payment plan and start the foreclosure process. It's a great thing to do. BK Chapter 7 is a liquidation. Doesn't mean they get to keep the property. Borrower family does not get to keep the house. You start the foreclosure process, or they do a deed in lieu, cash for keys. If they won't comply, then you foreclose and take the asset back. It just is what it is. Okay. Let's dive in. Questions about the exit strategy before we dive into, is it a deal or is it a dud? All right. Let's go. Now, when you're buying it, notes, there are some different things you want to consider that come in handy. When you're doing due diligence, let's look at the servicing notes. What is the seller? Has the seller called in? Has it all been the servicer reaching out? Are they working numbers, non-working numbers? Look at the payment history. These are things you're going to get. You know, why did they go default? Why did they stop paying? Have they been paying on time for a while and then had a death in the family or something? Obviously, look at market values. Are those going up or going down in that area? Look at the days on market. That's a very important aspect. How soon, if you do take the property back, could you sell it if it's marketed at the right price? You're not going to get interior repairs, but always expect paint and carpet. All right. If it's an elderly person, probably got to have to update the appliances and light fixtures. It's little things, but major ones are always going to be the roof, the foundation, and those are the two of the biggest things. Obviously, look at the foreclosure time frame in that state. What's going on with that state? If they haven't foreclosed already, I always like what's going on. Why haven't you started the foreclosure process between now and then? Look at your neighborhood variables. Is it in a good area? Is it in a bad area? Drug deals going on. High crime rate. Reach out and check for zoning violations or issues from the county code enforcement. All right. City government issues is a big thing. Like we were buying one note one time, and the city was actually condemning properties in those areas because they were going to turn this area into a man-made lake. So our property that was securing our note was going to become underwater, literally. So it was a good reason not to close on the deal. Okay. Like I said, look at crime map. Is in a good area, bad area. Size and population of the city. We talked about that earlier on, why you want to be in a relatively good sized city so there's plenty of people there. Look at the exterior condition. Is there toys? Is there a flag? Is the lawn mowed? Is there pride of ownership? Those are definitely things to look at. Rural locations are not bad, but I try to stay in most of the suburbs. Okay, rural. If you're fine buying rural, okay, rural. But for the most part, you're gonna have better luck staying in towns. And one thing is always look how far it is to local college. Is there a college in that town? If it's near a college, it may make sense to take the asset back and keep it as a rental, or that becomes somebody you could potentially sell the asset to is landlords in that area. So that's something to keep in mind. Okay. Does the asset meet your strategy? What you're looking for? Cash flow with performing or reperforming. Large checks with deed in lieu, cash for keys, or REO sales. So that's the thing. You want it. When I always say when somebody comes to me and says they want to leave their job, okay, well, how much do you want to make? Well, I want to make 10 grand a month. Okay. Or I need 10 grand a month. Okay. So let's divide that in two, 60 grand and 60 grand. Well, 60 grand can come from some foreclosures, a deed loans. The other 60 grand, let's create a cash flow system of performing notes to pay that coming in. Okay. I want to own real estate. Well, that's going to take a little bit difficult, but you could do that taking properties back and keep them for rentals or owner financing you want, which I don't really like. You want to avoid weird assets and unfinished projects, guys. Just stick with cookie cutter single family homes for the most part, or condos in parts of the country. I always try to make sure that the asset has three profitable strategies. And the three profitable strategies are it gets reperforming, and it's a good cash flow if it's occupied. If it's vacant, I know it's not going to reperform that way. Two, if I can get a deed in lieu, cash for keys, and get the property and get it rehabbed in 6 months, is that going to be a good deal? And then if I have to take it to foreclosure, am I going to make money at the foreclosure auction or taking the property back? Those are the three most important things. Rental and new note origination. Some people like to focus on those. I'm just not a fan of those, ladies and gentlemen. The ROI on them doesn't make sense. Oh, you can foreclose and then refinance out. Well, you can't really refinance out a new note or new REO for 90 days. Okay. Well, I'm going to originate. Well, what about your profit? You can't, it makes more sense to sell the property most of the time. Now, there's sometimes you're buying it really cheap. Like I bought a lot of cheap notes back in the day. It made more sense to hold those for cash flow, modify them. So work that out on the cash flow side. Sometimes it just doesn't make sense. But sometimes it will. Okay. So asset by asset class, take a look at it. Okay. A big question asks if his deal has legal started. Ask to speak to the attorney or get your questions answered from the attorney. Review the servicing notes and the collateral file for hardship letters and background of the borrower. Check the bankruptcy. If there's been a bankruptcy file, check out pacer.gov. Review the state's statute of limitations when it comes to debt. If the borrower isn't paid in 10 years, you need to go check what the statute of limitations to collect on debt is in that state. If it's 10 years and the statute of limitations is 4 years, guess what? You got to say goodbye to 6 years of debt. That may still be a good deal, but you also need to know that you're not overpaying for the asset too because that legal balance is not correct. Then you also states like Florida, Colorado, Nevada that have safe harbor laws in case you're buying that will wipe out HOA liens and stuff like that. So keep an eye on that and know what that means. Like in Florida, there's a thing called safe harbor where if I buy the note and foreclose, I've only got to pay the HOA or the COA either 12 months of HOA fees or 1% of the original sales price of the property. So that comes in handy. Okay. Let's move on. 12 is no due diligence. This is something Obviously, we've got a due diligence spreadsheet checklist that we use with our classes. It's longer we'll go through here, but this is kind of the overview of what to look for. So your due diligence is divided into basically three things: the borrower, the property, and the collateral file. Okay. You're going to worry about the property first and foremost, and the borrower kind of the front end. The collateral file and more of the actual value of the property condition is going to come afterwards. So it's kind of a mixture. Okay. Longer due diligence video and the note due diligence video replay here for you to check it out. One of the borrower due diligence is servicing notes, responsiveness, right party contract. Has there been any trouble? Are they friendly? Do they cuss out the borrower? Cuss out the lender. Look at the previous loan documents, the loan application, see what they did. We talked about bankruptcy reports. They'll report anything they have on bankruptcy filings. It's a really great due diligence. We use whitepages.com or spokey.com to find current phones, addresses if we're trying to track down the borrower on there or family members. We also use social media sleuthing on Facebook, LinkedIn, Twitter to try to track the borrowers down. Okay. And then if we can't find them or anywhere information, we'll use neighbors and family members to try to find those people as well, as far as, especially if we bought the note for due diligence, or not due diligence, but to get them to come to the table. But we also do in the front end due diligence, see, hey, are they posing from the property? Are they bragging about driving a new car, vacation, that kind of stuff. We'll also look at past and present employers to see if they're working currently, to see if they're a good fit. The property. Obviously, you got to know values. You're going to use online and in-person things, but you're going to always use as is 30-day. You're going to use online valuation on the front end, and then in-person values after your bids have been accepted. You're going to look at the exterior condition of the property. We talked about this earlier. Do they have flags? Do they have toys? All that kind of stuff. Obviously, each market is different, so looking at the days on market conditions, but always, always, always put eyes in the asset before funding. That means paying for an exterior BPO, a realtor, somebody to drive by the property, make sure it's the right property. You always want your comps that are being pulled to be nearby sales. You start getting rural, they're going to be rural. It's harder to determine values when it's rural. And in some cities, it's also hard to determine city by city in a lot of cases too, block by block. Memphis is like that. Every city is a little bit different there. Sorry, not every city. Every block in Memphis is a little bit different. Okay. Once your offer is accepted, then you'll pay for a BPO or a comparative market analysis from a realtor to drive by the property. But don't do that on the front end until your offer is accepted. Yes, if the value is different, you'll be able to fade your bid and reduce your bid. Always check taxes owed and any pending tax sales. Call the county to find out. Look for code enforcement or zoning liens. It's pretty easy to call the code enforcement. If the property looks like it's rough, it's probably got a code enforcement lien. Okay. Look at neighborhood activity. Your Google Maps will give you a bit of an idea if there's trash, if there's burnouts, if it's in the hood, all that good stuff. Talk to the local police department too. Look for previous MLS listings, rental postings online. Check your rent rates to see what, because especially when you got a lot of Airbnbs and stuff like that in different areas, check what the rent rates are in case it's something that makes sense for that for you. Also, always look for HOA or COA limitations. In some cases, you may not be able to owner finance. You may not be able to rent it, right? Or it's like a 55 plus community, like down in the villages. You're going to have to rent it, sell it to somebody that's old. Okay. Look for any special assessments. We're seeing a lot of that in condos where they're coming and giving $100,000 special assessment to upgrade the whole unit, okay, or the whole complex. And then always look for your crime maps. What's going on in that area? Is it good, bad, or ugly? Okay. More about the property. You will not get internal access most of the time. Sometimes in reverse mortgages, you will. Okay. If it's listed for sale, that's a good aspect. Send a realtor out, pull online photos. Use Zillow values for your upfront due diligence and the BPO once it's under contract. Make sure. You can use narrpr.com as a free AVM tool for realtors. You can call utility departments for more info if because you have an interest in it. Since you're the bank, call the utility departments, the water, the sewage, to see if those things are on, if they're up to date. Okay. If the value comes back lower than expected than what they say, you can always reduce or fade your bid. And if they won't, or the condition comes back and it's a shithole, cancel your bid and walk away, and no harm, no foul. Okay. But always, always, always put eyes on an asset. If an asset within like an hour here, I'll drive and go take a look at it. If it's like I'm in Austin, so I'll drive down to San Antonio, in the afternoon, go look at 2 or 3 assets. Same thing if it's up in Dallas, I might drive up on a Saturday, go look at 4 or 5, something around. If it's in Austin, I'll sure definitely go drive and take a look at it. It's just worth my time. And it becomes something besides my eyes in an asset, but also something I can use for marketing. Okay. Collateral due diligence. This is important. Your loan file, you want to make sure the original loan documents or the mortgage is in there. You want to make sure there's a chain of assignments for every time that note's been sold, that there's an assignment for every sale. That means there's also a need for having a allonge that's associated with every sale. Okay. You want to make sure there's a deed trust. Usually that's going to be filed with the county. It's pretty easy to pull up, so you don't really need that. If there is a previous appraisal, a previous BPO, look in that. Sometimes that's provided by the sellers. The original loan application the borrower filed will sometimes be there. You always need to see some sort of financial information on what the borrower filled out to see what they could do to qualify. You don't get these oftentimes with owner finance sellers, so be careful. Some people use like rental application softwares. I don't like that. That's why I like buying institutional paper, because they actually filled out a 1003 report listing everything they have and what they're making and credit reports and stuff like that. Okay. Now, there's a difference. The collateral file that I held in my hand, that's called a hard collateral file. You're not going to get that till 30 to 45 days after you fund. You're going to get a soft collateral file, which is just basically scanned copies, PDF of the file. Look through those. There's something missing that, and then ask for them to see if they've got an update or something. Now, the reason the hard collateral files are great is after we fund, we get those in 30, 45 days. I still look through those because you'll find information there that's not been scanned. I found checks, pictures, keys to the house, deed and liens already signed. So always review your collateral files. It's important to do that. All right. Questions before we dive into our team of vendors. Okay. Now, the beauty about note investing is this is a team-driven sport. You, as a note investor, should not be on the workout side of your asset. Okay. Now, if you're owner financing, I get it. You probably do that. But if you're truly a note investor, you're going to be on the, hey, I'm finding deals and raising capital. I'm marketing for those two things. The workout you're going to put in the hands, and this is all the heavy lifting. This is the proof of concept. You're going to put that in the hand of vendors to help you out with that. Okay. Your trusted team is going to be your servicing company. You can use Madison Management. You can Allied Servicing when you're starting off. You can use FCI if you want, but they're not very good. Every servicing company is good, but they have also got bad things. All right. So just keep that in mind. SN Servicing is a little bit more expensive, but they've got stuff available as well. You're going to need a title company to not close on, but to pull O&E reports. We've got a few to choose from. You can actually go directly to weclosenotes.com and order a title update or an O&E report directly from our website. It's free to do. Just go to the vendor tab. Okay. Also, another company out there, Pro Title USA, will do that for you as well. Okay. You're going to need valuation in companies to pull BPOs. If you've got a realtor, great. Use a realtor to pull comps for you. Make sure they've driven by the property. Take a look at it. You're going to need foreclosure attorneys. Most of your servicing companies or other investors will have referrals for you. If you don't, then you can always go to Legal League 100 to pull one in an area for you as well. My biggest thing is the servicing companies or referrals, or just to take over and retain the foreclosure attorney on file. Okay. Special servicing companies, these are companies that work in the workout side of things. There's a few of them out there. Some have come and gone. When you get to that point where you're buying 20, 30, 50 notes, let me know. I'm glad to introduce you to one. Singer Law Group was a group that was out in Irvine. Daniel Singer, I think he still does this a little bit for some folks, but you've got to usually have more than one note. Okay. Otherwise, you're going to want to hire a servicing company and have them do the full thing. Or a few of our students have hired an asset manager from a service company to do that. That's what we have. We've had that in house for a while. Okay. Collateral review and storage company. You don't want to hold your collateral files in your house where little Timmy or little Tammy can draw on it or pee on it or the dog can eat it. All right. So you may want to hire a company to hold it. To review your collateral file is really important to do on the front end side, especially when you're getting rolling. You can hire Joel Markovitz, CSE out of Dallas, Richmond Monroe out of West Branson, Missouri. These companies will review your collateral files. CSE and Richmond Monroe will help you fix any holes that are in that for an a la carte charge. What we do, since we've looked at it up, we know what holes are missing. We can usually get stuff found ourselves in-house, but we actually have a storage unit that holds all our collateral files for the last 15 years. Realtors are important. If you have a local realtor in that market, that's great to pull comps, be your door knocker, stuff like that. If you don't have a realtor, you can go to realtor.com, nar.com. We've also got a couple networks of realtors that we can reach out to as well for you. So just reach out to me directly. Property insurance company, you want to use a couple. Ross Diversified out of Orange County, National REI Group, Lloyd's Group out of here in Texas is another company we use. Property preservation companies to winterize. Most of the time, you're going to use that through a realtor. Your servicing company may have somebody to do that. There are a couple companies out there that will help do that for you. And then as far as BPOs and things like that, broker price opinions, skip tracing, you can also order those things directly at weclosenotes.com under our Venture tab. Something new we're just offering, but we are started doing it for our WC Income members and one-on-one coaching students, but now you can actually do that directly through us as well. Okay. Any questions, any comments before we dive into what comes next and we let you go for the day? All right. So what comes next? As you sat through here for right at about 3 hours here today with me, we've been honored to have you. Lots of great stuff happening out there. But guys, the next step for you is to sign up for our 3-day workshop at notebuyingfordummies.com. This is the creme de la creme workshop. It's online. Some of you guys that are looking to do an in-person class, if you'll let me know, we'll let you know when and if we're going to do an in-person class the rest of the year. We did one in April here in Austin. We might do 1 or 2 a year in person. Usually we'll do 2 to 3 online workshops, so it's easier for people to travel to. You're not paying money on travel costs. I know budget is getting a little tight for folks. But our online workshop, notebuyingfordummies.com, you can go to that, get signed up for that today. It's a full day on finding notes, a full day on funding and marketing, and Sunday's all about exit strategies and making money. And we've had so many successful students going through our coaching programs, going through our workshops. John and Veronica Gore closed on 20 notes with an average of 22% ROI. Cal Ewing's about 12 notes, including one that's made over $150,000 in profit. Phil Berdure's closed on 14 notes and more. 50K profit on one. Larry Hoffman's bought 50 plus notes, 6 figures. Catherine Bell's bought 20 plus notes, made 6 figures. Keith Holland's bought 4 notes, 3 performing, 1 NPN. 25K on one alone. No, it's actually more, 90K on a profit where he paid 15K for 1 note. That's new. Paul Riley's bought some performing notes, usually seen a 12% or higher ROI. Dimitri Armstrong bought 1 note, basically 20K in profits. Sterling James has actually bought more than 1 note, but he bought 1 note in 90 days and turned in a 28% ROI on that performing note. So we actually did a case study on it so you guys can understand it. So go to our website. Go to our YouTube channel, our podcast, the Note Closer Show. Check out episode 943, where we walk through the deal, how we found it, the numbers behind the numbers, and how it turned out. And we'll probably have him on actually to talk about that deal plus other deal he's working on right now. But like I said, guys, our next virtual note buying workshop is July 25th through the 27th. That's a Friday, Saturday, Sunday. We'll run from 10 a.m. to 5 p.m. or 6 p.m. probably Central Time because we've got a few folks from California. So we'll start it not at 9 a.m. at 7 a.m. their time, but 8 a.m. their time. And it's through Zoom. Like I said, we'll go 10 to 6 on Friday, Saturday, take an hour lunch break. And then on Sunday, we'll run from probably 10 to 3, 10 to 4, because I know that your mind can only absorb what you're asking to withstand. All right. And it's recorded. The great thing is you don't have to wait till July 25th to start learning. If you get signed up for our workshop today, we'll send you the replays to the previous online workshop 2 months ago. And that way you can start learning from there. We'll also throw in some bonuses. You get the replays as a bonus for you and your spouse or you and your partner. We also will do a 4-week coaching implementation coaching program after the workshop for 4 weeks, okay, to help hold your hand through the process. You'll also get a free Lawful and Associates Entity Secrets class for $99 value. We'll also give you access to our wholesaling and calling banks master classes. Those are $199 a piece. We'll also give you to our due diligence master class too for $200. We'll also give you our 20 by 20 find and fund video training series that we did. That's a $5.99 value for you guys. And then, like I said, you can bring your spouse or partner and have them watch either with you or at a different location at no additional value. We'll give you the code for that. And then we usually will bring on an exclusive note pool for you to bid on. All right. And that's a nice thing that most people do. We'll bring on a new pool of assets that we'll be breaking down during the class and going through it. We'll go through different case studies as well throughout the class that you can learn from. And the great thing is that if you want to, you can actually bid on some of the assets that we go through or point you in the right direction. And all those bonuses add together over $2,500, over like $3,000 in value for you to help you out with that. Okay. We're not here These are things that can help you, a lot of education, a lot of valuable for you. Okay. Like I said, it's notebuyingfordummies.com. Normally the cost is $9.97 we do, but since we're teaching this class, we offer you up a 50% discount. And so if you go in and just go to Note Buying for Dummies and go to checkout, it will automatically deduct that down to $4.97 for you. Okay. Um, and if that's a little expensive, a little tight for you, I understand. We do have our monthly membership. You can spread out your learning costs at $97 per month. If you go to noteumbrella.com for that, you can get signed up for that. And you just sign up for that for 6 months. You'll get access to the workshop. You'll get access to Note Camp. You'll get access to all the trainings and online stuff. Now, we do have our one-on-one coaching program too. Folks take the 3-day class and, hey, I really like this. I want to kick ass. I want to be like John and Veronica, closed on 20 notes in 90 days, or, Catherine and who's Cal, who have made over 100K in their first couple deals, or Larry, who's made 6 figures in his first 12 months. We can help you with that. This is your hand holding. You're working truly with yours truly. What's involved in our coaching program is we do 8 weeks minimum of one-on-one coaching calls with yours truly to help you. We do it in the morning, the afternoons, the evening. All depends on when your schedule is available. Hold your hand through the process. Get you rock and roll, making offers, raising capital. We're going to give you a list of 5,000 plus asset managers. We're going to introduce you to 12 hedge fund managers with deals. So you go right to the top of the line to get deals sent to you on an automatic basis, not going through me, but directly. We'll give you 1 year of the WCN membership included. We'll help you with raising private capital by helping you set up your pitch deck and help you pull lists of IRAs, help you write those letters, those postcards, stuff like that. You're basically going to get VIP access to me. All right. Not just for 6 months, but as long as you want me around. Okay. After those 8 to 10 weeks of coaching calls, then you come and spend 2 days with me here in Austin, one-on-one. And everybody's different. Everybody's a little bit different aspects. So we focus on what is going to be best for you. All right. Not what's best for everybody, but what's best for you. Everybody's got strengths and weaknesses, and go from there. We also will do it after you come in person, we'll do a 6-month follow-up Zoom day. What do you need help with? Where are you going? What's going on? What frustrations? But you can book quick phone calls with me throughout the time afterwards. We get all sorts of people that will book a phone call with me on my Calendly link, and I'll look at tapes. I'll look at bids. We'll look at and walk them through studies. My coaching students reach out to me because they are my students, but they're really my family. Okay. And the most important thing is we will help you find your first deal to get this paid for. All right. Or to reimburse you back for what you're paying for the class, because the coaching is a little bit more of an investment than $97 a month or $497. All right. Our coaching is $24,997, just under $25. We do payment plans. We also offer a $5,000 discount if you pay in full in 30 days. All right. So that's something people take advantage of. They're like, okay, do I need to stretch this out, or can I, if I can pay 10 grand down now and we'll do the other 10 in 30 days, that's a pay in full. We'll drop it down to 20 grand for you. Otherwise, it's 25 grand, and we can set up payments for you. We also have a 24 to 36 financing model for you. It's third-party financing through a company called Ease, because our coaching does so well. If you got 2 years of W-2s, you make 40K per year, and you get 620 FICO or greater, they more likely going to finance you. And they'll spread that over 2 to 3 years for you. Okay. Monthly payments can be as little as $500 a month. There's no prepayment penalty, and there's no payment due for 45 days. So you can get signed up, get approved for that, and literally in just a couple hours, and you find out you can qualify for the full amount. If so, great. They fill it out. They wire you the money. You turn around and wire that to us, and you're rocking and rolling. And without having to make a payment for 45 days. We've had some folks actually buy a note, get a note closed in under 45 days that pays for their coaching. That's paying the $500 or less, or a little bit more per month. Depends on where your situation's at. This is a great, great strategy if you hit those first things. It's 2 years of W-2s, 40K per year, and a 620 plus FICO. Okay, pretty easy. If this doesn't fit, talk to me, and we still may be able to find a way to have you partner up with somebody or structure something that's going to work well for both of us. But we're here to help you get things done. Like I said, total cost $25, paid full 30-day discount, set up monthly payment plans. It's a full year of coaching really for you, and we have a 95% success rate. Why is it not 100%? Because I can't guarantee everybody taking action. We had one guy went through the coaching, wouldn't do anything, wouldn't do any marketing. I can't help him. Wouldn't make any offers. You only want to do one little thing. I can't help you on that. Okay. But another guy went through the coaching and then disappeared. I can't help you if you disappear after the fact. Okay. But like I said, we've gone through the different options there for you guys to get this finance. If you're interested, please reach out to me. We'll shoot you a link that you can get approved for in hours, not days. It's a really simple link to go to, see what you qualify for, and get rock and rolling. But that is what we're here for. Biggest thing is, guys, get signed up for our workshop, notebuyingfordummies.com. Take advantage of that 50% discount at $497. Get you the replays, get you off rock and rolling, all the other bonuses included for you. We want you to go to the top, and we are the best at doing it if you're in the note business. All right. So get signed up today, notebuyingfordummies.com. Get the 50% discount, and we'll see you at the top. Any questions, any comments, any concerns before I let you go for the day? We're right at 3 hours there. That's not so bad, huh, ladies and gentlemen? Right at 3 hours. Under 3 hours to go through this stuff for you. Our obviously what we cover here is just a Cliff Notes version of what we cover fully in the 3-day workshop. All right. If there's no other questions or comments, we'll let you go. Get signed up today, notebuyingfordummies.com. That's notebuyingfordummies.com. Have a great rest of your week, and we'll see you at the top, everybody. Bye.
Hey, real estate investors, this is Scott Carson. I'm known across the country as a note guy. For the past 20 years, I've been buying distressed assets, primarily non-performing notes on residential and commercial properties. And if you've ever wanted to learn how to dive in to start buying non-performing notes from banks, hedge funds, or other investors like yourself, then there's no greater place than to get the nuts and bolts, the A to Z, the 1 through 99 place to get started. It is our virtual note buying workshop. We've been teaching this class since 2010 on how to find, fund, flip non-performing notes, how to get banks to call you with deals that you can cherry pick. And no, you don't need millions. No, you don't need a lot of experience to start looking at non-performing notes. We get the lists of notes from banks, hedge funds on a regular basis, not 1 or 2 or 3 or 4, but hundreds of deals that we can evaluate and cherry pick. Whether we're looking for performing notes or non-performing notes that we can get reperforming, or non-performing notes you can foreclose and take back, whatever your niche or whatever you would like to focus on, we can help make it happen at the virtual note buying workshop. It's a 3-day class. Our next one is April 18th to the 20th. It's actually online live via Zoom. You get signed up by going to notebuyingfordummies.com. That's notebuyingfordummies.com. Day 1 is all about how to find these assets. How do you find asset managers? How do you find lists of people to reach out to that you don't have to spend thousands of dollars on postcards or letters that you waste money on? We don't do that. Day 2 is all about raising capital and marketing and how to create a business that feeds itself, that you can do part-time, 10 hours a week, 5 hours a week, depending on what your focus is. We'll show you a game plan to achieve deal flow coming in on autopilot versus you having to send a ton of money. And also, we'll show you how to raise capital like nobody else does. And then day 3 is all about the flip. How do we structure deals? How do we evaluate a tape to find the deals from the duds? All right. We'll show you what vendors to use. We'll give you a 200+ page manual, contracts, sample forms, all the stuff that you need to be a lean, mean note buying machine when you get wrapped up. Now, yes, this is live April 18th through the 20th online via Zoom. Get signed up today. We'll send you the replays of the previous online workshop so you can start learning, start evaluating material, and get rock and rolling. And if for some reason you don't like our class, we have a 100% money back guarantee involved with it. If at the end of the first day you don't like what we talk about, you don't think it's impactful, just let me know. We'll refund back your tuition, no questions asked. We don't want your money. We want you to become a note buyer. We want you to become a lien lord. All right. Like I said, if you're tired of dealing with toilets, tenants, and trash outs, you don't want to deal with renters, then becoming a note investor is the path for you. Everybody evolves into a note investor at some point, but there are plenty of opportunities out there. There are millions of non-performing notes that you can cherry pick. No, it's not all junk. It can be small value all the way up to $1 million homes or $1 million apartments for you. So much opportunity is taking place right now in the chaotic market that we see. And who's going to come out on top? Note investors will. So take the time, get signed up today, April 18th to 20th. Go to notebuyingfordummies.com or go to our website, weclosenotes.com, and sign up for the virtual workshop there. As always, get signed up today. We run discounts all the time. The cost of tuition is you plus your partner or spouse. So get signed up today at notebuyingfordummies.com, and we'll see you at the top.